Chapter 1, Financial Protection Provided by Accident and Sickness Insurance. Accident and Sickness, A&S, insurance is defined as insurance that provides one or more of the following benefits to the life insured. Benefits for loss due to accidental bodily injury. Benefits for loss due to accidental death. Benefits for loss resulting from sickness or disability. Benefits for loss due to death, and benefits for health care, including dental and preventative care. In brief, A&S insurance relieves insured individuals of the burdens of medical expenses or income loss arising from illness, injury or necessary medical treatment not covered by the provincial health insurance plans. 1.1. For individuals and their families. A&S insurance protects an individual or a family from the burdens of medical expenses and income loss arising from a health crisis due to physical injury, an illness that prevents an individual from working, increased medical expenses from a health condition, and the need to pay for long-term care. Financial goals of individuals and their families. The majority of families have similar principal financial objectives that require regular cash flow as well as supplementary cash to be invested for the long term, although the amounts and requirements will vary family to family. Wealth accumulation. Setting up an emergency fund, equivalent to 3 to 6 months' current living expenses, is an important and immediate need that must be set up once primary needs, that is, food, accommodation, clothing, means of travel, etc., have been provided. The emergency fund should be 3 to 6 months of current expenses. It provides a financial cushion against unforeseen events. After establishing an emergency fund, additional money not needed for living expenses can be saved for short and long-term goals. Such goals can include investing in a vacation property, investing in a portfolio to provide current income or growth for retirement funds, education savings, and developing a legacy for heirs. Retirement income. Retirement requires a source of income. Retirement income pays the costs of living as a retiree. All retirees have one thing in common, the requirement of income in one degree or another. It is often highly desirable to have more income available than simple needs require. Retirement income comes from many sources such as government pension plans, Canada or Quebec pension plans, CPP and QPP, and old age security, OAS, employment pension plans. Private pension plans, registered retirement savings plans, RRSPs. Non-registered investments. Inheritances. Part-time employment or self-employment. Liquidation of assets. Some of those sources do not require input from the individual, for example, receiving an inheritance. The majority of retirement income sources result from saving and investing while working for many years prior to retirement, such as a registered retirement savings plan, RRSP. If disability, sickness or economic downturns interrupt the ability to work, income may not be available to save for retirement needs and wants. The agent plays a key role in assessing and determining which life insurance product best suits the needs of clients to ensure their financial protection. This is particularly important in the area of disability where products are needed to replace income during periods of disability. Family needs. Families have many needs for income, both to pay the cost of basic living and the extras, such as holidays. For example, tuition for children's education, orthodontics, vacations, etc., all must be provided for before retirement. Wants and needs change over time. Some, such as care for a disabled child, demand special attention for a lifetime. It is very important that families generate income and set aside savings to meet these continual family needs prior to retirement and prior to, or concurrent with, investing for wealth accumulation. Financial risks that threaten individuals and their families. In order to meet the financial objectives outlined in the previous section, the client must be able to generate enough income and savings over time. There are many risks that could interrupt family financial goals, such as unexpected expenses, loss of income or savings, lower standard of living, inflation, longevity, and debt. Unexpected expenses. A budget should ideally help clients prepare for their future financial responsibilities in terms of their current income. Clients vary in their ability to make a realistic budget as well as stick to it. Costs that would arise as a result of an accident or medical condition are not usually planned as part of a family budget. Medical issues can create an unexpected expense or, if an issue is already being accommodated, can increase the cost of the expense. Both are detrimental to the budget and its objectives. Example 1. Sandra was riding her bike to work when she was hit by a truck. She was hospitalized for 7 months and, due to a severe concussion, may never practice law again. She also has a need for at-home caregivers, physiotherapy, and many prescription drugs. Her personal savings are being rapidly depleted by this unexpected expense. The possibility of having to sell her house and move the family into an apartment is looming. Example 2. Darren suffers from depression. His family manages the cost of his prescriptions. As his depression worsens, Darren needs new drugs that are 10 times more expensive. His family finds it difficult to manage the increased cost. Loss of income. When an individual begins a career, financial security is usually fully dependent on generating more income to save and invest rather than just for living expenses. It may be impossible to save for future needs when income is lost due to job loss, injury, illness or disability. Loss of savings. When income is lost, savings may provide a stopgap between what is being received and living expenses. If savings are depleted, there could be a permanent effect on the financial situation, or there could be a temporary hardship while more income is directed towards rebuilding savings. Lower standard of living. A lower standard of living is a result of other risks resulting in personal financial loss, such as the loss of income, loss of assets, loss of savings, etc. The family's diminishing financial circumstances could cause them to sell their cars, downgrade to a smaller home, eliminate family vacations, and so forth. This domino effect could be avoided if the client has A&S insurance. This lower standard of living could also affect the family psychologically, deterring them from future productivity, earning the same income again and restoring their standard of living. Inflation. Inflation is a general increase in prices. The increase in prices results in the decline in the purchasing value of money. Example. Using the Consumer Price Index, CPI, as a guide, for example, a basket of goods that cost $100 in 1996 cost $147.65 just 20 years later in 2016, an increase of 48%, during a period of historically low inflation. Looking at the long term, $100 worth of goods bought in 1916 costs $2,132 one century later. Inflation fluctuates. For example, using the Consumer Price Index, CPI, in Canada's recent past, inflation has been reasonably low, 1.24% in 2013, but further back in Canadian history it was much higher, 12.12% in 1982. An income that does not keep pace with inflation will have less purchasing power. In other words, salaries have to increase simultaneously with inflation for the worker to maintain his standard of living. Individuals on fixed incomes, such as retirees, face this problem because their salaries do not increase with inflation. An important tool for calculating inflation in Canada is the inflation calculator found on the Bank of Canada website. Longevity. Lifespans for men and women are increasing. For example, in 1900 many men did not even reach retirement due to their life expectancy at birth of 46.3 years. By the year 2009, the life expectancy in most provinces for males increased to 77 years. Since the age of retirement has remained virtually unchanged at age 65 for many years, this means people spend more years of their lives in retirement than previously. There is a risk of outliving one's money if the amount of retirement income needed is underestimated. In other words, the money runs out before the life ends. Therefore, clients need to acquire more retirement assets to avoid outliving their money. This need is heightened because seniors often incur more healthcare costs due to health problems or potentially needing extra care at home or in an institution, that is, a nursing home. For example, it is increasingly rare for seniors who need medical assistance to live with their families. They usually go to live in a retirement home, nursing home or chronic care facility, depending on their needs. These facilities can be extremely expensive. They can drain the seniors' savings and leave them in a position where they are dependent on the government or their children. These factors underscore the importance of clients saving for retirement while they are able to earn an income. These factors also demonstrate that retirees without enough savings to support their costs in retirement leave their children with little or no estate. Debt. Debt reduces net worth. It refers to the value of a person's assets minus his liabilities. Debt can destroy financial plans and objectives. In 2013, total household debt in Canada rose to $1.1 trillion in mortgage debt and $500 billion in credit card debt. Carrying costs, or interest, is the biggest concern when it comes to debt. Credit card debt is especially worrisome due to the particularly high interest rate that is charged on unpaid balances, 18 to 24% or higher. If income is interrupted and debt cannot be paid, an individual may face difficult decisions and severe and long-lasting repercussions. Repaying the debt with its extra interest charges may create a financial strain. Debt servicing typically comes out of current income. A client's failure to take care of his debt could result in higher interest payments as well as, in extreme situations, in lawsuits, foreclosure and bankruptcy. Therefore, it is very important to put in place insurance to replace the client's own capacity to generate income or cover medical costs. Many Canadians entering into retirement have substantial debt which can impede the long-term sustainability of their retirement plans. Personal risks that threaten individuals and their families. Personal health risks also pose a critical potential risk in interrupting financial plans and compromising financial security. These include likelihood of disability, loss of independence, and costs of long-term care. These health risks will be discussed below. Likelihood of disability. Disability in Canada refers to when an individual has difficulty performing tasks due to a long-term condition or health-related problem and experiences a limitation in their day-to-day life. The rate of disability increases with age. According to the 2012 Canadian Survey on Disability by Statistics Canada, about 3.8 million, 13.7%, Canadians over the age of 15 reported a disability. From ages 15 to 64, 1 in 10 working-age persons reported having a disability. From ages 65 and older, 1 in 3 seniors reported having a disability. Women, 14.9%, experience a higher rate of disability than men, 12.5%, and 26.0% of persons with disabilities were classified as very severe, 22.5%, severe, 19.8%, moderate, and 31.7%, mild. Loss of independence and costs of long-term care. As people are living longer and receiving better health care, more of them are living with serious cognitive, such as Alzheimer's, and physical, such as Parkinson's disease, medical conditions. This leaves individuals unable to care for themselves and needing long-term, institutionalized care which can cost upwards of at least $3,000 per month. The cost of assisted care for adults is high. Such an expense amortized over years of care can seriously erode the value of an estate. Example. Daniel's long-term care facility costs $8,600 per month. When he went into care at age 62 with early onset Alzheimer's, he had pension income of $3,200 per month and a $1 million estate. The current rate of expenditure shows his estate will be depleted in about 15 years. The pension income is insufficient for the cost of the facility. What will happen to Daniel when the money runs out? Needs met by accident and sickness insurance for individuals. A&S insurance can provide needed funds to buy time for employees, the self-employed, business owners and their families. A&S insurance provides security and protects the individual's income, savings, assets. This section looks at how A&S insurance protects income, savings, and assets. Protection for income. Disability income protection is one of the most common forms of A&S insurance. The coverage replaces the income of a sick or injured worker who is no longer able to work. Regular income from working is replaced by income from insurance after a specified waiting period following the onset of disability. No benefits are payable during the waiting period. The policy limits the benefit to a specified period or age or to when the disabled returns to work. Example. Raul is an independent contractor working in the plumbing trade, earning $80,000 a year. In order to financially protect his family in the event that he becomes disabled and unable to work, he has taken out a disability income replacement, A&S, insurance policy. The policy has a 90-day waiting period, a monthly benefit of $4,200 and a 5-year benefit period. If Raul was to be injured and unable to work, after waiting for 3 months, the policy would begin to pay him $4,200 a month for up to 5 years, to replace income lost due to disability. Protection for savings. As discussed, one of the primary financial goals of an individual is the accumulation of both short-term and long-term savings. Unexpected occurrences can cause a decrease in both short-term and long-term savings. Extended health insurance, another form of A&S insurance, is insurance to protect savings from expenses caused by sickness or disability. This greatly reduces the financial impact of many of these risks by providing the insured individual with cash for medical costs and to replace income. For example, travel insurance is a form of extended health insurance that pays the costs of sickness for a Canadian traveling in the U.S. Example. Mrs. Johnson, who runs a consulting sole proprietorship business, was injured in a slip and fall accident in January and was unable to work for 8 months. As a result, she was unable to earn her regular $5,000 a month of consulting fees for those months, resulting in a nearly 50% reduction in family income. The Johnson's son was hit in the mouth with a puck in a recreational hockey game and required over $10,000 of dental reconstructive surgery. And the Johnson's daughter developed a serious viral infection requiring 10 days of hospital treatment in a private room, at a cost of $125 a day over and above what the provincial health plan pays. Fortunately, the family has extensive A&S insurance coverage, both private and through Mr. Johnson's group plan where he works. All of their daughter's $1,250 of extra hospital expenses were covered under the group plan, as was $5,000 of their son's dental expenses. And Mrs. Johnson has a disability income replacement plan that paid her $3,000 a month for 5 of the 8 months that she was off work, a total of $15,000. Without adequate insurance coverage, the Johnson's savings would have been reduced by $21,250 or $1,250 plus $5,000 plus $15,000. Protection for assets. Long-term care insurance, another form of A&S insurance, is insurance to protect assets. Therefore, estate value is not eroded because assets remain in place to ultimately pass on to heirs and beneficiaries. Most Canadians save for their retirement, although the amount saved varies for each individual. The general intent is that the savings not spent during retirement are passed down to their heirs. However, health issues prevalent among seniors often drain retirement savings and estate assets, leaving a depleted legacy to pass on to heirs. Long-term care and critical illness insurance both protect this from happening by maintaining the value of the estate through providing benefits to offset much of these costs. Example. Eudora, age 69, never earned a large salary and had no pension plan at her place of business. However, she did manage to accumulate about $250,000 in RRSPs and non-registered investments, in addition to her $150,000 home. To date, she has been able to manage on her $1,250 a month, $15,000 a year, in government benefits and some interest and dividends from her investments. Eudora just discovered that she has a degenerative disease that will force her to move into a nursing home, at a cost of $2,750 a month, $33,000 a year. Despite her health problems, Eudora has a normal life expectancy of age 85, 16 more years. The shortfall in her income versus the cost of a nursing home would require Eudora to liquidate $18,000 a year of her assets, $33,000 minus $15,000, reducing her estate by about $290,000 over her lifetime, $18,000 times 16 years, money she had planned to leave to her 3 grandnieces. Fortunately, Eudora took out a long-term care policy when she was in her mid-50s. The policy will cover $1,000 of her monthly expenses, $12,000 annually, reducing the erosion of her estate to less than $100,000 over her lifetime, $18,000 minus $12,000, times 16 years equals $96,000, and enabling her to still leave a substantial legacy for her family. 1.2. For business owners. The needs and goals of business owners that require protection are, in many ways, similar to those of individuals and their families. That is because the business owner does not exist in a vacuum, he is both an individual and, often, a member of a family. The sections below describe goals, risks and needs of business owners as they relate to accident and sickness. Goals. Generally, private business owners have similar goals which can potentially fluctuate over time. These goals are often directly related to goals that the business owner holds as an individual, such as business profitability, income protection, business succession, capital protection, sale at fair market value, protection of estate value. These goals will be discussed in the following section. Business profitability. Initially, survival is the main goal of a new business owner. Once the business takes off, profitability and growth become the principal goals of a business. Profitability is key for a business to succeed long term. Continuity is central to business profitability. Business succession. Business succession refers to the passing on of a business to a successor, family member, employee, etc. Many business owners hope to pass their business down to their children. This is often not possible due to poor planning, even if the children are willing to take over the business. In cases where the children are willing to take over, a lack of proper preparation can result in the business failing before any transition can be effected. A disability or illness of the business owner could ruin his plans to pass the business along through succession. There could be nothing left to pass if he has not been able to work and keep up the revenue stream and operations. Business overhead insurance, NA&S product, is a possible solution for this need. Sale at fair market value. Often the children cannot or do not want to take over a business. In these circumstances, the best case scenario is to plan in advance and sell the business at its fair market value. A fire sale refers to when the sale of a business is sudden and unplanned. In this case, competitors or possible successors seek to benefit from the situation by buying the business for much less than what it is actually worth. Ideally, business owners should plan in advance and find a suitable buyer to purchase their business. They make a deal with the buyer to buy their business at a fair market value using the appropriate legal tool, that is, a buy or sell agreement. This ensures that the buyer has enough funds when it comes time to buy the business. Life insurance addresses the need to sell a business at fair market value if the business owner or partner dies. Disability income insurance addresses the need to sell a business at fair market value if the business owner or partner is disabled. Chapter 5 of this manual looks at how accident and sickness insurance helps to secure the needed funding and accurate legal documentation to ensure that a disabled business owner can acquire the business at a fair price. Business risk. The success, or failure, of a business can be due to many different internal and external factors. Risk refers to the chance that a given result might occur. Risk is both systematic, common to the business environment, or unsystematic, unique to the client's specific business itself, that is, business risk, rather than to the market or the economy as a whole. Business risk impacts the profitability and success of the business as a whole. The good health of the business owner and key employees is essential to business survival. Risk management. The costs associated with the risk of business failure due to disability or illness can be managed by self-funding or insurance. Self-funding. Self-funding is a form of risk retention that refers to the business owner or partner personally paying for the costs that arise in his business due to his absence as a result of sickness or disability. The costs of business could include payroll, rent, inventory, etc. An individual has three options to self-fund the cost of a loss associated with a risk. 1. Pay the cost out of current cash flow. 2. Borrow to obtain funds to pay the cost. 3. Use savings or sell assets. None of these options are ideal. Borrowing money is not always a viable option and can be expensive in the long term. The business owner should ideally have enough money saved to cover a period of time when he is not able to work. Insurance. A business owner's best option is to insure against the possible loss incurred by risks, such as death, disability or medical expenses caused by injury or illness. Insurance is based on the transfer of the financial impact of a risk, from a potential insured to the insurance company. A&S insurance transfers the risk of loss of income or medical expenses to the insurance company. A modest premium paid to the insurance company will assure that the necessary funds are in place to replace income lost or expenses incurred due to disability or illness. The insured person will lose their premium if they do not need to file a claim, but the amount paid to the insurer will most typically be less than the amount that would be incurred if the insurance was not purchased. Life insurance pays a death benefit when the life insured dies. A&S insurance pays a benefit when there is an accident or illness. Needs met by accident and sickness insurance for business. Two principal factors are prevalent among successful businesses, particularly small or private businesses. Owners and/or key employees generating continuous revenue. Hiring and retaining quality and valuable employees. A key employee or business owner having an accident or falling ill could potentially be tragic for a business. A&S insurance policies benefit both business owners and employees. Business owners with A&S policies protect the revenue stream for the business and cover business expenses, rent, staff salaries, etc., through business overhead expense, BOE, while the disabled owner or employee regains back his or her health. Attract and keep employees thanks to the appealing benefits offered by A&S insurance. Employees of a business with A&S policies know that they will continue to receive income to support themselves and their family if they are off work due to accident or illness. Know that their benefits will cover their medical expenses in the case of accident or illness. Example: Ingrid is the sole owner and primary salesperson for a small import-export business that rents office space in an industrial mall and employs 3 staff. Last month, she was in an automobile accident and was injured severely enough that she was off work for 7 months. During the period of her disability, which promised to be temporary, the income of the business declined by 70% after the first couple of months. Without cash flow, the business would be forced to close its doors. However, Ingrid had the foresight to take out a BOE disability insurance policy on herself, which would pay out up to $15,000 a month to cover ongoing business expenses. The funds were sufficient to pay the rent and staff salaries and keep the business operating until such time as Ingrid was able to return to work. Chapter 2: Insurance to Protect Income. 2.1 Sources of Income. Disability income, DI, insurance replaces income due to the inability to work. Many types of DI insurance coverage are available. Anyone who is insurable from a medical perspective and earns an income may acquire DI insurance coverage from the following sources: An individual disability income insurance policy obtained directly from the insurance provider. A group insurance coverage, as an employee or member of a union or association, that offers group insurance coverage. Creditor insurance provided by a lender to its borrowers. Provincial workers' compensation boards, and disability pensions through CPP and QPP. Individual disability insurance. An individual disability insurance contract is structured with a policyholder, who is also called the insured, refers to the individual who pays the premium and collects the policy benefits. A life insured refers to the individual whose disability initiates the disability benefits. The life insured is often the same person as the policyholder. The life insured is the person who receives the benefit of the policy, for instance, the monthly disability income benefit, and may be called the policy beneficiary. The life insurance company provides the policy benefits. Therefore, individual DI contracts are entered into between the applicant, who is often both the policyholder and the life insured, and the insurance company. Generally, the policyholder is the premium payer, the life insured and the beneficiary under the policy. DI policies are purchased by individuals to replace income in the event of a disability. Business owners to replace financial loss incurred in the event of the disability of a key employee or employer. Insurance for business use is examined in Chapter 5. Premiums paid are not tax deductible and benefits received are not taxable under individually owned DI policies. Group disability insurance. Plan members under one group policy receive group disability insurance. A group disability insurance contract is structured with the policyholder, the sponsor of the group, the life insured, the group plan member, the life insurance company. The most common group disability insurance contract is an employer or employee group plan. In this case, the policyholder is the employer and the employees are both the life insured and the beneficiaries. The underwriting characteristics of the group as a whole determine the price of the group coverage. Creditor disability insurance, and other providers. DI coverage is often offered by creditors, that is, commercial lenders such as a bank, to borrowers, that is, their clients. Creditor disability insurance ensures that borrowers can repay their loans if they become disabled. Creditor disability insurance pays the scheduled monthly loan repayments of an insured traditional loan for the disabled borrower. The minimum monthly payments of a credit card outstanding for the disabled borrower. Creditor disability insurance is provided through a third party or an affiliated insurance company. Typically have a 90-day waiting period. Have a very strict definition of disability. Mortgage disability insurance compared to individual disability insurance, traditional. The mortgage DI market is a specialized subsection of creditor insurance. An individual who has a mortgage can acquire disability insurance that will make monthly mortgage payments if he becomes disabled. Mortgage insurance can be provided through the financial institution that has provided the mortgage or through a personal policy. Insurance provided by the lending institution is issued as a group policy. Is the less expensive option. Has various restrictions and limitations, underwriting is limited and less stringent. The borrower is the mortgager and the financial institution is both the mortgagee and beneficiary. Insurance in the form of an individual income replacement policy is more flexible in how the policyholder can use benefits. Is the more expensive option. Premiums tend to be higher than mortgage insurance arranged through the lending institution. Provided after full underwriting. The life insured is the beneficiary of the DI policy. The borrower has the intent to use a portion of the claims to cover the monthly mortgage payments. Table 2.1 demonstrates that both approaches possess unique strengths and weaknesses. For comparison of mortgage disability insurance and individual disability insurance coverage, see Table 2.1. 2.2. Individual disability insurance, DI. There are various types of individual DI policies, each defined by the benefits it offers, the factors used to calculate premiums, and the riders that may be added to it in order to customize the coverage offered. Types of individual policies. Many types of individual DI policies exist. Each policy is defined by its benefits, premiums, and riders. Personally owned DI policies can be differentiated in the contract by the number of guarantees provided to the policyholder. An absolute guarantee policy can never be altered or cancelled. An increasing premium. Contracts that can be terminated by the insurer at any time. The following most common types of DI policies are discussed in the following section. Non-cancelable policies. Guaranteed renewable policies. Cancelable policies. Guaranteed issue policies. Non-traditional disability insurance plans. Non-cancelable policies. Referred to as a non-cancelable, non-can, and guaranteed renewable contracts. A non-cancelable policy offers the most guarantees to its policyholder. The life insurance company cannot cancel the policy. Policy premiums cannot increase. Policy benefits cannot be reduced or changed. Carries the highest premium. Every year, the insurer renews the policy until the life insured turns 65. The policyholder is the sole individual who can modify the policy, subject to underwriting if applicable, before its maturity. Typically, at age 65, the policyholder has an option to convert the policy, without proof of insurability, to a guaranteed renewable contract with a shortened benefit period generally ranging from a year or two. Premiums are based on the insured's age when the policy is converted. The guaranteed renewable policy typically ends when the life insured is 72 or 75. Guaranteed renewable policy. With guaranteed renewable policies, the life insurance company is bound to renew the policy every year until the policy matures, typically at age 65. But the insurer has a right to change the premiums unilaterally. The premium cannot be changed for an individual insured. Any change must apply to the entire class of policies that impact all lives insured under the class type. The policyholders have to be notified of any changes in the contract at least 30 days before a change or cancellation takes effect. All changes are put in place at the annual policy renewable time. Usually issued with an any occupation definition of disability. Available to higher risk occupants. Cancelable policy. A cancelable policy is also issued on a class basis, meaning that all policy changes must apply to all of the policyholders. The policy of a sole individual cannot be altered. It offers the fewest guarantees to the policyholder and carries the lowest premiums. The life insurance company can cancel the policy, reduce or change benefits, and increase premiums at any time without the policyholder's consent. The policyholders have to be notified of any changes in the contract at least 30 days before a change or modification takes effect. A cancelable policy is issued to higher risk occupations, that is, laborers, taxi drivers, etc. Because of the lack of long-term certainty afforded the policyholder, all other factors being equal, premiums for cancelable contracts will be lower than those for other policy types. Guaranteed issue policy. The guaranteed issue policy is an individually issued policy only offered by a few insurers. It is an alternative to traditional long-term disability, LTD, group insurance. A guaranteed issue policy guarantees the coverage of the insured and is issued to individuals who are members of low-risk groups, such as lawyers, doctors, etc. The premium is higher than an equivalent group plan. The insurer can cancel the guaranteed aspect of the plan at any time by refusing to accept any further lives insured on a guaranteed basis. At the time of the application, applicants must be actively at work and not on a disability claim. Due to the plan's guaranteed nature, the guaranteed issue policies may incur certain restrictions based on the size of the group, occupational class of the group members, minimum annual premium commitment, minimum aggregate age for the group members. There are two forms of guaranteed issue plans. 1. Guaranteed standard risk. Coverage is guaranteed to be issued without coverage restrictions or premium ratings. Often there will be extra restrictions based on the plan's administration, such as every member of the group may be required to participate or that 100% of the premiums must be fully paid by the employer. The reason every member has to participate is to avoid anti-selection, which refers to when an imbalance occurs in the risk levels presented by employees. A potential unbalance could occur if only higher-risk employees subscribed for the plan and lower-risk members opted out of the insurance. 2. Guarantee to issue. Coverage is based on medical underwriting. These plans guarantee to issue some form of coverage, though not exactly the coverage applied for. Non-standard risks, that is, people who pose a higher degree of risk than standard risk, may pay a higher premium, called a rated premium, or issue an exclusion rider. If an individual poses a higher risk due to a particular hobby or activity, coverage may exclude a claim that arises from that hobby or activity. For example, if a person participates in scuba diving and becomes ill as a result of scuba diving, his claim may be denied. Non-traditional disability insurance plans. Insurance companies are responding to changes in the Canadian workforce by introducing new policies and easing up on restrictions. In the 21st century, there has been a significant growth of self-employed workers in Canada. By 2012, 15.4% of Canadian workers were self-employed contract workers. These changes have had a significant impact on disability insurance and the main market of employees for which it has traditionally provided DI insurance. Insurance products must align themselves with the changing work market. Employers typically do not provide benefits for contract workers. Contract workers often seek out standard disability coverage but find that sickness coverage is not practical because it is too expensive or requires too long a waiting period to be beneficial. Contract workers prefer an affordable accident and sickness policy that would initiate immediately upon accident or illness, that is, first-day benefits. Many insurers have made the accident and sickness elements of their DI policies distinct and separate. This policy insures against the loss of income due to either accident or sickness, but not both. Other insurers are changing the definition of disability to better suit the changing market. For example, changing the definition of total disability to the inability to perform specified functions instead of job duties. This new definition includes the work of the self-employed contract worker because workers who are not employees offer skills to a workplace instead of services and duties outlined in an employee contract. For example, offering an income-based definition of disability which bases disability on the inability to earn a specified percentage of regular income due to disability. This definition also acknowledges that job services often differ between contracts. For example, changing the definition of disability to the inability to find new contracts due to disability, thus offering disability benefits to unemployed self-employed contract workers. Some plans offer special benefits to an insured who may not have gainful employment, such as an individual who provides full-time care to their children or who perform volunteer service. These policies provide the insured with limited monthly benefits to contract out the services the insured was providing in the past, such as babysitting, volunteering, etc. Policy benefits. Individual disability insurance is more involved than simply providing monthly income benefits to insured members who meet the policy's definition of disabled. Disability insurance, DI, policies differ in terms of benefits such as the amount of benefits paid, when benefits commence, the duration that benefits are payable, if they are payable at all depending on the circumstances, amount of benefit. One of the risks faced by disability insurers is that an insured will act differently due to the disability insurance being in place by claiming to be disabled or still disabled. In such cases, DI insurance potentially gives an individual the opportunity of earning an income without the need to actually work. Disability benefits from individually owned DI policies are tax-free. The maximum benefit of a DI policy is typically no more than 60% of pre-tax active income, That is income earned from performing actual work. It is not 100% of income because the disability benefit takes into account income tax and other benefits normally applicable to business income. This is easy to calculate when an individual solely earns a salary or self-employment income. Therefore, the formula for the disability benefit based on active income is pre-tax income times percentage of DI coverage equals disability benefit based on earned income. Example 1. John earns $100,000 per year. His income of $100,000 is taxed at about 40%, his take-home pay is $60,000. His disability benefit would pay $60,000 and he would not pay tax on the $60,000. Example 2. Heinrich is a sole proprietor, working as a consulting computer technician. Most years, he earns $70,000 in consulting fees and has about $12,000 in business expenses. After allowing for income taxes annually, he gets to keep roughly $44,000 of the $70,000 that he earns. Based on his pre-tax income of $70,000, an insurance company would offer him maximum DI coverage of about $42,000, $70,000 times 60%. This is close to the $44,000 that he gets to keep, after tax, while he is working. He is financially neither advantaged nor disadvantaged if he is on a disability claim, minimizing the chances that he would submit a false claim or artificially prolong a valid claim in order to continue receiving an income without working. It is more difficult to calculate the disability benefit if the insured has sources of passive income not earned by performing work, on top of his earned income that continues during a period of disability. Insurers treat the continual, passive income as part of the disability benefit and reduce the disability coverage accordingly. If the insured were to receive the disability benefit in addition to their passive income, they will have little incentive to go back to work. The reduced disability benefit avoids such situations. In this case, the total income will be reduced by the passive income and the percentage of DI coverage, maximum of 60%, will be based on the final sum. Therefore, the formula to calculate the disability benefit, taking into account passive income that continues during a period of disability is earned income plus non-earned income, times percentage of DI coverage, minus non-earned income equals disability benefit based on earned and non-earned income. Example. Consider the case of Heinrich, above. Assume that, in addition to his earned income of $70,000 a year, he has income from a family trust of $20,000 a year, income that will be paid to him whether he is working or not. If the insurance company were to ignore the trust income and issue him $42,000 of disability protection, during a period of disability, he would receive $42,000 a year from the insurance company and $20,000 from the trust, or $62,000 a year of total income, almost 89% of his gross, pre-disability earned income. There would be little incentive for Heinrich to return to work. Even if the insurance company were to include the $20,000 of trust income in Heinrich's computation of earned income, he would end up being overinsured. 60% of Heinrich's total income of $90,000, $70,000 in fees plus $20,000 from the trust, equals $54,000 a year in disability benefits. However, Heinrich would still be receiving the full $20,000 from the trust, making his total income $74,000 while on the disability claim. This would represent about 82% of Heinrich's pre-disability income, well in excess of the 60% threshold that would place him in a neutral position. In this case, the insurer would be willing to insure a benefit equal to 60% of Heinrich's total pre-disability income of $90,000, or $54,000. However, the coverage offered would then be reduced by the $20,000 of trust income that he would still be receiving while disabled, leaving a DI benefit of $34,000. The combination of the disability benefit and the trust income would then total $54,000, or 60% of Heinrich's total pre-disability income of $90,000. Waiting period. The waiting period is the time between becoming disabled, onset of disability, and receiving a benefit. It is also called the elimination period. The waiting period can be as short as 0 days, or as long as 12 months. 90 days is the norm. The longer the waiting period, the lower the premium. The least risky occupational classes receive the shortest waiting periods. All factors being equal, policies with a shorter waiting periods charge higher insurance premiums. Benefits are not paid during the waiting period. The waiting period is in place to avoid paying for disabilities of a very short-term nature. These short-term temporary disabilities are too expensive for the insurance company to pay in terms of administrative costs for the short duration of the disability. Example: Alfred injured his leg in a fall while hiking on the weekend. He was unable to work for 8 months. His DI policy has a 90-day waiting period and a maximum 24-month benefit period. Because of the waiting period, the insurer paid out 5 months of benefits, 8 months of disability less the 3-month waiting period, rather than the full 8 months. Benefit period. The benefit period is the maximum length of time benefits are paid by the policy. Benefits stop if the life insured is able to return to work or the benefit period has expired. Example: Simon has a policy with a 5-year benefit period. He returns to work 3 years after his disability occurs. His benefit stops when he returns to work. Example: Jen also has a policy with a 5-year benefit period. She is unable to return to work until 6 years after her disability occurs. Her benefit stops at the end of year 5. A person might be disabled more than once. Typically, each disability instance is treated on an individual basis. The full benefit period could be applicable to each disability. For example, for a policy with a 5-year benefit, the insured could claim up to 5 years of the benefits for each disability. The most common benefit periods of long-term disability are 2, 5, 10 years, and to age 65. The most common benefit period of short-term disability insurance is 10 to 26 weeks, longer in some cases. The longer the maximum benefit period provided by the policy, the higher the premium. Exclusions and limitations. All policies have certain common exclusions. If the individual becomes disabled due to an activity listed as an exclusion, not covered by the policy, the individual will not receive the disability benefit. These exclusions are not related to the health, vocation or lifestyle of a specific insured, but apply to all persons insured under the type of policy. The most common exclusions include disabilities, caused by the following situations, for which disability benefits would not be payable, are: war, terrorism, self-inflicted wounds, attempted suicide, illegal activities, normal pregnancy and birth. If the life insured presents a higher than standard risk that he will make a claim, the policy may be issued with a reduced monthly benefit, increased waiting period, or reduced benefit period. Denial of benefits. Benefit will be denied and therefore not be paid when the following situations occur: misstatement, fraud, absence of loss, absence of proof, delay. Misstatement. If an insured makes a false statement or a material misrepresentation, meaning he misrepresented or forgot a fact that would have affected the underwriting of the policy and this is discovered within 2 years of the policy issue date, the policy can be made void, that is, declared legally invalid, by the insurance company. The 2-year period is called the contestability period because after 2 years, the policy becomes incontestable. The contract is potentially voided based on the notion that if all the information and facts were initially accurately presented to the insurance company, the policy might never have been put in force in the first place. For example, failure to disclose a previous back injury that could have impacted the underwriting decision is a misstatement. Fraud. Fraud is when the insured attempts to, or is successful at, deceiving the insurance company in order to receive a policy or pay a lower premium. If the misrepresentation was made by mistake, that is, The applicant forgot about a health factor and honestly assumed it was not important to disclose, then no fraud is presumed to have taken place. Fraud always voids a policy regardless of when it is discovered. A false claim refers to when an insured commits fraud at the time of a claim. If the insured makes a false claim, the insurer holds the right to call the entire policy and deny the claim. Absence of loss. Benefits are only payable under a disability claim if the claim is both proven to be valid and there is evidence of income loss due to disability. The life insured must show income to substantiate his claim. If his income when he makes a claim was lower than the amount he was insured for, the claim will be adjusted to reflect the actual, lower, income. For example, if the individual is unemployed or has a reduced income when making the disability claim, his benefits will be potentially reduced or denied altogether. Example: Haroon took out a disability income replacement policy in 2009 when he was earning $60,000 a year, which, if disabled, would pay him a $3,000 monthly benefit equal to 60% of his income, 12 times $3,000, divided by $60,000. By 2014, Haroon had lost his former job and was now working for a different employer at a reduced salary of $48,000 a year. If Haroon was to become disabled now, his maximum monthly benefit would be only $2,400 a month, equivalent to 60% of his current salary, $48,000 times 60% divided by 12. Absence of proof. Medical proof of disability must accompany a claim that he is, in fact, disabled and unable to work. An individual cannot just say he is disabled and receive a disability benefit. A prolonged period of disability will require ongoing proof. The insurer will at the very least request a medical report from the insured's doctor. The insurer might additionally request a medical exam and/or other tests from a physician chosen by the insurer. Delay. A claim must be filed no later than 90 days after the disability occurs, or by the deadline specified by the insurance company in the policy. Insurers have the right to deny benefits if a claim is not made in time. In an ideal situation, the insured should contact the insurer right away following the beginning of the disabling condition. Rehabilitation benefit. It is best for all parties involved if the disabled insured returns back to work as soon as the insured can safely and practically work again. The insured will begin earning his full salary again. The employer will regain the insured's skills and services. The insurance company will no longer have to pay the claim. Rehabilitation is not mandatory under DI policies, but it is highly encouraged by the insurance company and is thus often reimbursed fully or partially by the insurer. The policy will outline the amount of rehabilitation services that are covered under the insurance policy, as well as a potential maximum dollar limit available for rehabilitation services. If the life insured plans to use one or more rehabilitation services, he must submit his plan to the company for pre-approval of the costs. Rehabilitative services provided for rehabilitation are the following, but are not limited to: physiotherapy, occupational training, medical treatment, job placement, psychotherapy. Benefits for recurring disability. Recurring disability occurs when a life insured returns to work after an absence due to disability only to have the disability, attributed to the same cause, reoccur. The life insured then stops working due to his disability and goes back on disability leave. In this case, the disabled worker could potentially be subject to 2 lengthy waiting periods without any payable benefits in a short period of time, a waiting period for the first disability instance and another waiting period when the disability reoccurs. Example: Ophelia injured her back in January of 2014, in a fall on ice in the parking lot of the office where she works. She was off work for 5 months, collecting disability benefits for 2 of those months after allowing for the 90-day waiting period under her DI coverage. 2 months after returning to work, she was forced to take time off again. Another 4 months in this instance, as sitting at her computer chair all day long aggravated her previous back injury. If she was required to undergo another 90-day waiting period for the second instance of disability, she would have received only 3 months of benefits during a period when she was disabled for 9 months out of 11. The recurrent disability clause in many DI contracts is designed to prevent the insured from having to undergo another waiting period when a disability reoccurs. For most policies, if the second instance of disability, resulting from the same clause, occurs within 6 months after returning to work, the situation is treated as one instance of disability and the second waiting period will not apply. The disability must be a recurrence of the original health condition, it cannot be a new condition. Example continued. In Ophelia's case, above, if her policy contained a recurring disability clause, she would not be subject to a second waiting period and her benefits would recommence immediately upon the onset of the second instance of disability, incurred after only 2 months back on the job. As such, she would receive 6 months' worth of benefits during the 11-month period, not merely 3. The disadvantage to a recurring disability clause is that the 2 or more periods of recurring disability can be treated as one benefit period without any interruption. Therefore, the disability benefit is calculated from the beginning of the first benefit period. If the benefit period is shorter, that is, 2 to 5 years, this could greatly affect the total amount of benefits received due to a disability that lasts for an extended period of time. This also means that benefits could potentially run out before the end of the second disability period. Example. Ryan hurts his back in a skiing accident. His disability policy has a 24-month benefit period, a 90-day waiting period. Ryan is approved for his disability claim and after 90 days receives his first benefit. 6 months later Ryan returns to work, and after 2 months finds he is unable to work due to back pain from the accident. He begins to receive his policy benefit again. It begins immediately, there is no waiting period. He has 18 months remaining in benefits, that is, the 24-month policy benefit minus 6 months benefit received, not 24, because of the benefits received under the first claim were deducted from his remaining benefit period. Benefits for presumptive disability. A presumptive disability refers to when the insured suffers from a specified type of disability or the injury is so severe that the individual is presumed to be disabled. In such cases, the waiting period is waived and benefits are paid for the full benefit period, even if the life insured is able to resume work at his previous income level. Presumptive disabilities include total and irreversible loss of hearing, total and irreversible loss of sight, loss of limbs, or a loss of the use of limbs, including both arms, both legs, and an arm and leg. The benefits start immediately even if the insured can return to work and fulfill all of his previous duties as well as receive his full salary right away. Therefore, loss of income does not have to be proven to receive the disability benefit, as is the case with most disability benefits. In order to receive the disability benefit, the insured must prove that the qualifying disability exists. The presumptive disability benefit is available in the majority of, but not necessarily all, policies. Survivor benefit. Some disability policies include a survivor benefit clause that if the life insured dies while receiving a disability benefit, a lump sum survivor benefit may be paid to his estate. A qualification period is sometimes required by the policy, such that the survivor benefit is only payable if the insured had been disabled for a minimum period prior to his death, for example, 12 months. Upon proof of death, the sum is paid in a lump sum and is usually 3 times the monthly benefit. Example. ABC Insurance pays David $3,000 a month for his disability benefit while he is unable to work due to injury. David suddenly dies in the middle of his disability claim. ABC Insurance pays 3 times the total monthly disability benefit to his estate. Therefore, David's estate receives $9,000, $3,000 times 3. Policy premium factors. Aside from the monthly benefit requested, a variety of factors impact the premium charged for a disability income replacement policy, such as the following: the insured's age, the insured's gender, the insured's health, smoker or non-smoker status, occupation, Definition of disability used. Claims history of the insured. The length of waiting and benefit periods for the policy. Each of these factors will be discussed in the subsequent section. Other factors not listed here and not specific to the life insured that also have an impact on the premium rate are: an estimate of investment returns on accumulated premiums and expenses related to operating. Morbidity tables in terms of assessing and evaluating the likely cost of taking on risk. Morbidity refers to the actuarial estimate of the risk of disability within segments of the population, broken down by age, gender, occupation, etc. These other factors will be examined later on in the study notes. Impact of gender and age. The life insured's age and gender are two of the most significant factors in setting policy premiums in a DI policy. In terms of gender, women experience a higher number of claims and length of disability than men. In terms of age, younger people have a higher risk of disability than those who are older, but the length of time they are disabled is shorter than for older people. Therefore, it is likely that men will pay lower DI premium than women of the same age group for the same coverage. Younger applicants will likely pay lower DI premium than older applicants. Table 2.2 is a sample table that demonstrates the risk of becoming completely disabled before age 65 for more than 90 days and the average duration of the disability. For sample morbidity table based on age, see Table 2.2. It may be noted from above that the probability of disability is greater among those who are 25 years old than for those who have already reached 45, though the average duration of disability is longer for those who have reached 45 years of age. Insurance carriers create similar morbidity tables based on their claims history with their target markets. Health issues. The overall health of the life insured, in the past, present and future, has a direct bearing on premiums and the underwriting process. Family issues will also be a concern when there is a genetic link to the life insured. For example, when health conditions are likely to run in the family, such as having more than one family member with breast cancer. Premiums and benefits are classified as standard life, reflecting the same degree of risk than the average individual. Rated, reflecting a higher degree of risk than the average individual. Uninsurable, reflecting an unacceptable degree of risk. If an applicant has health issues, an exclusion of coverage for specified causes of disability may be offered. The applicant will receive the same standard premium and benefits if he lives an average life and thus likely faces the same risks of disability as the average individual. The applicant will be denied insurance or will be subject to higher premiums, which do not include coverage for particular causes of disability, if the applicant has a history of health complications, or is still injured or ill. If an applicant files a disability claim within 1 year of the application, the condition that led to that claim may be classified as a pre-existing condition. Insurers often state in DI policies that, under a 1-year exclusion rider, any pre-existing conditions may be excluded from the coverage for the year following the issue of the policy. Many sources of information are used to compile the medical picture of the applicant, including an attending physician's statements, a PS, from the applicant's doctor, non-medical form on the application, perimedical exam from a nurse, if required, full doctor's medical exam, if required, blood, saliva and urine samples, data from the Medical Information Bureau, MIB, inspection report from an investigator for lifestyle issues. Definitions of disability. Disability can be defined in several different ways ranging from partial to total, and within that range, there are 4 distinct definitions of disability. Different definitions of disability are used by different policies. Typically, the disability's cause is not considered in the definition. Workers' compensation coverage, which deals solely with work-related injuries and illnesses, is the exception and takes into account the disability's cause. The 4 main definitions of disability used in DI are: own occupation, regular occupation, any occupation, and total disability, according to the CPP. Partial disability will be defined and examined later in this chapter. Own occupation. The own occupation definition of disability is the easiest policy under which one can be qualified as disabled. The insured is seen as completely disabled if he cannot carry out, even part of the time, his main duties at work. The insured never has to return to work post-disability if he cannot perform the primary duties of his regular occupation. He returns to work once he can perform all the main duties of his regular occupation. Furthermore, he can take another job in another occupation and continue to receive his disability benefit. This type of policy is only available to the highest classification of occupants, those who are least likely to make a claim, such as doctors, lawyers, dentists, etc. Own occupation carries the highest premium due to the generous benefits provided to the life insured, and the larger policy purchased by high-income professionals who qualify for a cheaper rate per $100. These individuals are the least likely to need to file claims and tend not to stay on claim as long as other occupation classes, who earn less and, therefore, have to purchase smaller policy coverage. Example. Tobias worked as a surgeon, earning $240,000 a year. 4 years ago, he was injured in his home workshop and lost all the dexterity in his right hand. As a consequence, he can no longer function as a surgeon. After rehabilitation, Tobias took up a position at the local medical school, teaching other surgeons the techniques that he had developed. He also travels on the lecture circuit and has published 2 books since his accident. In total, he now earns $300,000 a year from his various enterprises, but, since he can no longer function as a surgeon, he continues to receive benefits under his DI policy, which has an own occupation definition of disability. Regular occupation. The regular occupation definition of disability has the same definition and same implications as own occupation, except if the life insured takes another job, the disability benefit may be reduced or ended. The decision about returning to work is made only by the life insured, even if he is physically able. Also available to those who are least likely to make a claim. Has a lower premium than own occupation. Any occupation. The any occupation definition of disability is applicable when the insured is seen as disabled if he is ill or injured and thus cannot carry out some or all of the functions associated with his regular occupation, and he is not able to carry out the functions of any other occupation that would be suitable for him based on his education or experience. It is the most stringent definition of disability, that is, since there are so many potential occupations for which the disabled insured might still be capable of performing. This type of policy is available to the greatest number of individuals, including those in higher risk occupational classifications. It is expected that the life insured who cannot work in his regular occupation will become employed in another job as a suitable alternative to his regular occupation, or benefits may cease. This type of DI policy has the lowest DI premium. Total disability according to the Canada Pension Plan, CPP. Total disability is the definition used by the Canada Pension Plan. The definition applies when the insured is totally unable to work at any job that he is suited for by his education and experience. It entails that the insured will likely never recover and be able to return to employment, that is, severe and prolonged, and may likely die from the cause of the medical condition. This definition is rarely used by conventional group or individual DI policies. However, it is used more often in creditor insurance coverage. Exception: in Quebec, the Quebec Pension Plan, QPP, defines total disability in slightly different terms. The disability must be seen as serious, inability to hold any employment on a full-time basis, as well as permanent, last indefinitely, without any chance of getting better. Occupational clause. Some occupations are riskier than others, and those who work in them are more likely to make claims. In underwriting disability insurance, the applicant's occupation is taken into consideration in terms of the applicant's insurability, the policy type available, the riders and benefits available, the cost, premium level, for the coverage. Higher risk occupations may not be offered policy types or benefits offered to those in lower risk occupations. Life insurance companies categorize occupations by the risk of claims being made. These are called occupational classes or classifications. The following is the most common form of classification. 4A. Professionals, such as doctors, lawyers, dentists and senior executives. 3A. Administrative office workers who face few, if any, workplace hazards, such as clerical staff. 2A. Supervisors in low-risk environments, salespersons and like occupations. A. Skilled manual workers who face few or no workplace hazards, or those working, for instance, as courier truck drivers. B. Manual laborers who work in hazardous environments, such as home construction workers. A lower premium would be available to the 4A occupation than the 3A occupation for the same coverage, lower premium for 3A versus 2A, etc. Certain policy types or benefits would not be available to those in higher risk classifications. For example, an applicant in the A class would not be able to likely get an on-occupation coverage. Most DI contracts have an occupational clause that if a life insured changes to a riskier occupation, he may find his premiums increase or his benefits are reduced. The reverse is also true. If a new job has less risk than the old, the life insured can ask for a higher classification. During the underwriting, those in higher risk categories may qualify for better consideration if they meet requirements for job and income stability. Even though the insured continues in a higher risk occupation, an upgrade would equate to a lower premium. A medical underwriting would be necessary to confirm that the insured has not developed into a higher risk for reasons other than his occupation. Example: Eunice took out a disability income replacement policy when she worked as an administrator in the office of a printing factory, a 3A classification. She paid $225 a month for her insurance coverage. 5 years later, Eunice changed jobs with the same employer and is now working as a staff supervisor on the floor of the printing plant, an A classification job. Her policy was guaranteed renewable, so she was able to keep her coverage, but her premium increased to $350 a month and her waiting period was extended from 60 to 90 days. Waiver of premium. A waiver of premium refers to an intrinsic provision of the DI contract in which premium payment is waived. That is, no premiums need to be paid by the insured, during the time the life insured under the policy is on a disability claim. Note that the waiver of premium is not a rider, as it is with life insurance policies. The premium for a disability income policy is waived, that is, not applied, when the life insured is receiving the disability benefit or to the end of the benefit period or to when the life insured reaches 65 years. Whichever comes first. The terms of the contract determine if the waiver of premium applies to the disability. Some policies only apply a waiver of premium involving total disability and sometimes partial disability. How does it work? Generally, the policyholder continues to pay the premium for the disability income policy for 90 days after he is totally disabled. After this period, the waiver commences. Many policies will refund the premium paid during the 90-day waiting period. The policyholder then makes no further premium payments for the duration of the claim or the period specified in the policy. Riders to address needs. Disability insurance includes standard provisions intrinsic to essentially all DI policies. These benefits and restrictions are often specialized to meet the circumstances of the insured. These special situations are met by the insurance industry by putting in place riders to policies. Riders refer to special provisions that are unique to that policy. They are put in place to meet the needs of the applicant. Concept of customization. Customizing refers to adjusting a standard DI policy's terms and conditions by adding riders to the contract. As stated, a rider customizes a policy to meet the needs of the applicant by adding, removing or restricting benefits according to the insurance company in order to minimize its exposure to risk. Some of the most common riders are discussed in the subsequent section. Differences between equivalent riders. Strict standards are not established for the definitions that apply to riders. Riders offered by different insurers need to be carefully compared and scrutinized in precise detail by the agent to be certain that they are equivalent. The agent should not assume that a specific rider will offer standard benefits within each contract even if there are standard definitions within the industry. Future Purchase Option, FPO. The Future Purchase Option, FPO, is also referred to as the Guaranteed Insurability Benefit, GIB, or the Guaranteed Insurability Option, GIO. FPO gives the insurer the right to increase the benefit at future times or on the policy anniversary without proof of insurability. However, the benefit payment can never exceed 60% of pre-disability earned income. Thus, if the coverage currently in force is 60% of pre-disability income, no further coverage can be purchased, even though the right to purchase coverage without medical evidence is guaranteed. In the past, around every 2 years, the insured was given the option to increase his coverage. Now, the policies issued offer the options to increase on the anniversary of the policy. Any new coverage attained under the FPO is issued based on the life insured's attained age at the time the option is exercised. Depending on the contract, options are usually available up to the life insured's age of 50 or 55. The ways in which attained age is calculated depends on the contract terms, that is, on age on last birthday, age on next birthday or age nearest a birthday. There is a maximum amount of coverage that can be purchased per option and overall. Each option is often limited to 20% of base coverage to a maximum of $1,500 a month of new coverage. The overall limit is in the range of 2 to 5 times the initial amount of coverage under the base policy. If the insured has remained in the same occupation, new coverage obtained through the FPO is based on the same occupational class as the original policy. The contract may allow the FPO to go into effect right away, or the exercise may be put off until the current claim's termination if the life insured is on disability claim when the option arises. The main limit in using the FPO is that the insured must qualify for the extra coverage from a financial perspective. The insured must provide the insurer with a proof of their current income. Exercising the FPO increases coverage, which in turn increases the premium. In terms of an FPO, no further coverage can be bought if the coverage currently in force is equal to 60% of earned income, despite the fact that the right to buy coverage without medical evidence is guaranteed. 2 rules are applicable. 1. The current option may not be exercised if the current income of the insured has stayed the same since policy issue or exercise of the last option, and the coverage currently in force equates to 60% of current income. 2. If the 60% of the current income of the insured is greater than the current coverage in force, the option may be exercised to a maximum of the current option or an amount that would bring the coverage up to 60% of current income, whichever is less. Example. Fritz was earning $60,000 a year, net as a freelance handyman 2 years ago when he applied for disability insurance. He qualified medically and financially and was issued a DI policy with coverage of $3,000 a month, 60% times $60,000, divided by 12. His policy has an FPO rider which permits him to increase coverage, guaranteed, by 20% of his original coverage, or $600 a month, this year if he can qualify financially. His income has increased by $6,000. to $66,000 a year. At his new income level, Fritz could qualify financially for $3,300 a month of disability coverage, 60% times $66,000, divided by 12. Since he already holds $3,000 a month of coverage, he could only exercise the FPO to acquire an additional $300 a month of coverage, despite the fact that the option allows for up to $600 a month of coverage without medical underwriting. Cost of living adjustment, COLA. Inflation increases the cost of living. Those who depend on long-term disability benefits as income will find that, over time, their purchasing power is reduced due to inflation and the fixed nature of the disability benefit. This is a problem that insureds face who depend on LTD benefits as their primary source of income. The cost of living adjustment, COLA, rider increases the monthly benefit being paid under a disability income replacement contract annually, beginning in the second year benefits are paid. The increase is either simple, the benefit is indexed by a set percentage increase, for example, 2.00% or 4.00% of the initial benefit payable. Compound, following the claim's first year, on a compound basis, the benefit is indexed to the rate of inflation and is thus increased by the CPI every year. In other words, the monthly benefit is increased based on the inflation rate for the previous calendar opposed to the initial benefit. Example: Jennifer is entitled to $3,000 a month in benefits under a DI policy indexed to the CPI and under which the COLA is compounded. The following table demonstrates how her monthly benefit will increase every year due to the compounded COLA. Year 1. Change in CPI. 3.10%. Annual increase in benefits. Not applicable. Monthly benefits. $3,000. Year 2. Change in CPI. 2.80%. Annual increase in benefits. 3.10%. Monthly benefits. $3,093. Year 3. Change in CPI. 2.50%. Annual increase in benefits. 2.80%. Monthly benefits. $3,180. Year 4. Change in CPI. 4.00%. Annual increase in benefits. 2.50%. Monthly benefits. $3,259. Some policies limit a maximum annual indexing rate, that is, 5%. Many policies may also carry forward an unused allotment to future years. For example, if the indexing rate for year 4 of a claim is 1.5% lower than the maximum allowed under the contract, that 1.5% can be carried forward to years in the future, to create more indexing room for years when the inflation rate exceeds the maximum annual indexing permitted under the contract. Furthermore, policies put in place a predetermined limit for the maximum amount of indexing so that the annual benefit paid out under an indexed policy does not surpass 2 or 3 times the initial, unindexed, annual benefit. An automatic coverage enhancement, also called an automatic benefit increase, is an alternative, not in addition, to the COLA rider offered by some DI policies. Every year the benefit automatically increases, without a medical or financial underwriting, by a small fixed percentage, that is, 2 or 3%, and the premium increases in step with the enhanced benefit. The enhancement may be reviewed and underwritten on a periodic basis, that is, every 5 years. The benefit provides an indexed policy with increasing premiums that applies the increase in coverage after the policy is issued and does not wait for a claim to be made. It basically attempts to keep up with annual raises that most employees receive. Accidental death and dismemberment, AD&D. The accidental death and dismemberment, AD&D, rider provides the insured with supplementary benefits not included in the regular benefits payable on account of income loss due to disability. If the insured dies or suffers from specific severe injuries due to an accident, the AD&D rider benefits are paid. For the claim to be paid, the death or injury of the insured must happen within 365 days of the accident. The death or injury must be directly related to the accident. In the case of death within 365 days of an accident, the AD&D rider is generally paid in a lump sum, referred to as the principal sum. In the case of injury, the AD&D rider is generally paid a percentage of the lump sum according to the severity of the loss, that is, the loss of sight, hearing, limbs, etc. Medical underwriting is not necessary when the rider is issued due to the fact that benefit place. This is due to the fact that if the insured would receive full benefits in the event of total disability but no benefits if he were to return into the workforce part-time, it would be hard to encourage a disabled worker to return to work part-time. Residual disability benefits. Residual disability benefits encourage disabled workers to return to the workplace as soon as they are physically able. A residual disability benefit is a type of partial benefit offered by many DI policies. This means that if the insured is able to work part-time following a total disability period, the disabled will receive a portion of his benefits. The life insured must first experience total disability, a complete inability to work, for a specified minimum amount of time including the waiting period, typically 6 months including the waiting period, to qualify for a residual disability benefit. When total disability has ceased, the benefit is paid if the disabled can return to work and perform some substantial duties or can perform all substantial duties some of the time. Therefore, once the insured returns back to work, he will be receiving two forms of income, both part of the disability benefit and the employment income. In order for an insured to qualify for residual benefits, there are specific requirements regarding both the insured's minimum and maximum income. Pre-disability income must be reduced by 20% or more to receive the benefit. In other words, if the life insured earns 80% or more of his pre-disability income, he will not receive the residual benefit. Therefore, if he earns between 20% and 80% of what he earned working, he receives a benefit in proportion to the percentage of income not received. The life insured will receive the full benefit if he earns 20% or less of his pre-disability income. There are 3 steps to determine the total income received by taking the residual benefit. 1. Determine the percentage of income that is lost, which is calculated as pre-disability income minus part-time income divided by pre-disability income equals percentage of income lost. 2. Apply the percentage of income that is lost against the full disability benefit received, which is calculated as full benefit times percentage of income lost equals residual benefit. 3. Add the residual benefit to income earned equals income received, which is calculated as residual benefit plus income earned equals income received. Example: Carol's pre-disability active income is $100,000. Carol has been receiving a total disability benefit of 60% or $60,000 per year, $5,000 per month. If she returns to work and makes $80,000 or more, she will not receive any disability benefit. If she returns to work and makes less than $20,000, she will receive a full disability benefit. She returns to work part-time and earns $2,000 per month or $24,000 per year. How much will she receive from her disability benefit and income? Step 1. What percentage of income has she lost? The percentage of income that she has lost by returning to work is pre-disability income minus part-time income divided by pre-disability income equals $100,000 minus $24,000 divided by $100,000 equals 76%. She has lost 76% of her pre-disability income. Step 2. How much will she receive as a residual benefit? Apply the percentage of income she has lost against the full disability benefit received. Full benefit times percentage of income lost equals $5,000 times 76% equals $3,800. She will receive $3,800 per month as a residual disability benefit. Step 3. What is her total income as a result of returning to work? Add the residual benefit to income earned. Residual benefit plus income earned equals $3,800 plus $2,000 equals $5,800. Carol's total monthly income will be $5,800. Therefore, she receives more income as a result of working part-time than on the disability benefit alone. Partial disability benefits. Partial disability benefits are paid by insurance contracts from the beginning of disability. This does not require a proof of total disability. When due to disability, the insured cannot perform some of his job's principal duties, or can only perform them for part of the time, The policy provides the insured with 50% of his total disability benefit for a specific period of 2 to 3 years. The benefits come from the partial disability benefit or the residual disability benefit, whichever is greater. The DI contracts generally ask that the insured be under the care of a physician. The insured undergoes an initial qualification period of total disability before the partial disability benefits will be paid to the insured. Partial disability benefits vary between insurance companies. The agent must ensure that the policy details are clear to an applicant. Return of premium, ROP. A policyholder may pay thousands of dollars of premiums over the course of their DI policy and never receive any of the money because they never needed to file a valid claim. The return of premium, ROP, rider addresses this concern and provides a tax-free refund of premiums paid if, when the policy expires, total claims paid are less than total premiums paid. For example, if by age 65, no valid claims have been paid, the insured will receive 70% of all premiums paid. If the total claims paid during the policy's lifetime are less than the total amount of premiums paid, the difference would be paid back to the insured upon the maturity date of the coverage. If the claims paid out to the insured surpass the amount of premiums paid, then no return of premiums is payable. Some policies state that the rider may also apply if a policy is canceled before its expiration date and no claims have been paid out on the policy. In this case, a partial ROP is often paid. Some policies also state that if the contract lasts for a specific duration, generally 8 or 10 years, without paying a claim, anywhere from 4 times the annual premium to at least 70 to 80% of the premiums paid during that period or a percentage of the annual premium will be paid back to the insured. This rider is expensive and may increase the base DI premium by 40 to 60%. Ratings and exclusion riders. When the risk that the life insured may make a claim appears more likely than what is considered standard, his application may be declined, not issuing the policy. Charged a higher premium, called a premium rating. An exclusion rider may be added to the policy. Declining the policy is seen as a last option. A premium rating is an increased premium which assumes substandard risks and compensates the insurance company for the additional risk it assumes. The premium rating does assume more risks than what is considered standard, but, on the other hand, it does not assume risks that are too high either. For example, an insured with an overall health issue such as diabetes will have to pay a premium rating to compensate the insurance company for the risk it assumes taking on a client with a health condition. The insured may have the option to have a medical assessment in order to have the option re-underwritten as well as the rating lowered or taken off altogether if the condition improves in the future. An exclusion rider will exclude a claim arising from a substandard risk such as a particular lifestyle, activity or condition that has a greater risk of causing a disability. For example, a scuba diver has a greater risk of becoming disabled than someone who does not scuba dive. Therefore, scuba diving would most likely be excluded from the rider. In these cases, the insurance company will issue the policy but with an exclusion rider, excluding the particular risky activity from the policy so that if a disability does arise from the identified activity it will not be paid. Typically, the contract would then be issued with a standard premium in order for other standard episodes of disability to be covered by the rider. Example: Eldridge applied for disability income replacement insurance despite the fact that he had a damaged disc in his back, the consequence of his sporting activities. The life insurance company was willing to issue the policy at standard premium rates, but with an exclusion rider that stipulated that no benefits would be payable due to a disability related to Eldridge's back problems. Hospitalization benefit. Basic disability income protection insurance solely replaces earned income. It does not cover additional costs incurred due to disability. Hospital costs are a common expense not covered by the standard DI policy. In this case, either a hospitalization benefit rider or a hospital indemnity rider can be added to a DI policy to cover those expenses. There are 2 hospital stay-related benefits available as riders. 1. The first day hospitalization benefit provides a benefit between the time when the life insured is admitted to hospital and the first day the disability benefits begin, typically 90 days later. The insured must usually stay in the hospital for 18 to 72 hours for the benefits to be payable. Its payment is made on a daily basis, as a percentage of the monthly benefit. 2. The hospital indemnity rider covers expenses that arise from hospitalization of the life insured, such as parking, childcare and transportation. Provided as a daily sum, usually between $50 and $250. Begins on day 1 of hospitalization, the life insured must stay in the hospital at least 24 hours. Coverage is provided for a maximum of 3 to 4 months. Taxation of individual disability insurance, DI, benefits. Whether the benefits are received as taxable or tax-free income impacts the amount of disability insurance for which an applicant can qualify. Tax-free benefits represent a greater proportion of the insured's pre-disability net income. Furthermore, the applicant's ability to afford the coverage is partially dependent on whether or not premiums paid for disability insurance can be deducted for income tax purposes. Tax treatment of premiums and benefits. Premiums paid for individual disability income replacement policies are not tax-deductible and benefits are received tax-free. Such is the case for the following benefits. Disability income benefits. Treatments received by the life insured and paid for by the life insurance company, for example, physiotherapy. Waiver of premium. Return of premium refunds, ROP, benefits. For businesses. A DI policy taken out on the life of an employee where the employer pays the premium and is a beneficiary of the contract. The policy premiums are not a tax-deductible business expense. Business overhead expense, BOE, is an exception to this rule. Different tax rules apply to individual DI policies taken out by an employer on a class of employees. If an unincorporated employer takes out a DI policy on an employee's life and the benefits are payable to the employee, the premiums are likely tax-deductible by the employer. Premiums paid by the employer or benefits received by the employee would be treated as taxable income for the employee, one or the other, not both. Further taxation of business insurance is covered in Chapter 5. Taxation differences between personally owned and corporately owned disability insurance, DI, policies. There is little difference in the taxation of personally owned and corporately owned disability insurance policies. Corporately owned DI policies purchased in order to compensate the corporation in the event of the long-term disability of a key employee, or to buy out a permanently disabled shareholder's interests, are treated the same as a personally owned DI policy. The premiums paid are not tax-deductible and benefits received by a corporation are not a taxable inclusion. If a corporate DI policy insures an employee's life, who is also the beneficiary of any policy benefits, the premiums will be a deductible business expense for the employer, and a taxable item to the employee for the year in which they were paid. If a corporate DI policy insures a shareholder of the company, or both an employee and a shareholder, the premiums will be likely administered as a shareholder benefit by the Canada Revenue Agency, CRA. Non-deductible by the employer and taxable in the hands of the shareholder. Conversion of policy. Conversion refers to a provision in most life insurance policies which states that the life insured may, with the same insurer, transfer a term insurance policy into a permanent policy without having to prove medical insurability. Non-term individual disability income insurance policies do not follow the same concept of conversion. A conversion clause will be included in BOE and buy or sell insurance policies. Certain types of business disability insurance policies may permit the life insured to transfer the policy and its benefits to a personal policy, that is, when the policy is no longer needed for business use. This converts the policy from a corporate policy to a personal policy. There is no medical underwriting when the conversion occurs, it happens when a claim is made. Also, DI policies that are non-cancelable often provide the policyholder with the choice to convert the policy at age 65 to a guaranteed renewable policy, with a restricted duration and benefit period. 2.3. Group disability insurance. Group DI insurance is provided to many individuals under one principal policy. A group disability policy establishes an employer as the policyholder and its employees as the lives insured and beneficiaries. Group coverage is often the only DI policy an insured has in his portfolio due to cost-efficient coverage. The insured does not have to do much administration at all. The insurance company informs the group members of the insurance benefits. Providers of group disability insurance. Group DI coverage is most often provided to groups members without proof of medical writing. Therefore, issuing the life insurance to a particular group provides the insurer with an element of shared characteristics among the group members, that is, they all have, more or less, the same amount of risk. Examples of groups that possess common characteristics are: they work for the same employer. They work in the same industry. They are members of the same association. They are alumni of the same university or college. They belong to the same union. The common characteristics offer at least two advantages. The existence of the group means the insurance company can underwrite a policy on its shared characteristics. Also, a central organization to administer the plan, enroll members, collect premiums, etc. Employer. Employer-employee groups are the most common type of group. The insurance provided is a valuable employee benefit and can act as an incentive for attracting better employees and keeping employees in the organization. Thus, many employers find it particularly important to offer employees competitive group coverage to engage and keep good employees. For the employee, it provides a simple, convenient and cost-efficient way to build a base for the risk management program. Association. Association groups refer to groups of individuals who belong to the same group insurance plan based on shared characteristics rather than working for the same employer. Two types of association groups exist. 1. Groups of individuals who have employers in common. May be formed by several employers in the same industry or by franchise owners from the same franchise organization, for example, the beauty industry or a sandwich restaurant franchise. The employees are the plan members. The members access the benefits of belonging to a group DI plan, that is, its cost effectiveness. 2. Groups of individuals who have professions or associations in common. May be formed by members of the same profession or belong to the same association, for example, doctors who belong to the Canadian Medical Association group plan or alumni from the University of Ottawa. Membership in the group plan is solicited by the plan administrator. No obligation to participate in the group plan. Members pay all of their own premiums and benefits. The members access the benefits of belonging to a group DI plan. Types of group disability insurance, DI, policies. Typically, disability coverage is divided into short-term disability and long-term disability. Each group contains several different definitions of disability, benefit levels as well as waiting and benefit periods. Short-term disability, STD. Short-term disability is also referred to as a weekly indemnity. It provides a benefit no longer than 1 year in duration. If disability persists after 1 year, short-term disability is replaced by long-term disability. STD benefits are based on a percentage of the insured's salary. The benefit amount is 70% to 75% of salary. Benefits are taxable income because the employer pays the premium. Benefit is higher than LTD benefits. The benefit period begins 7 days after disability caused by illness. The day that disability is caused by an accident. The own occupation definition of disability applies. Therefore, the benefit is paid if the disability of the life insured prevents him from working at his regular occupation. Example: The company Myron works for offers its employees a group disability plan which includes both STD and LTD coverage, providing for a combined 5-year benefit period, 12 months for STD and 48 months for LTD. Normally, Myron earns $4,000 a month when working. A couple of months ago Myron injured himself when a golf cart that he was riding on during a weekend tournament tipped over and badly damaged his leg. Myron's job as a plant supervisor requires him to walk around the plant regularly to oversee the work of the employees, so his injury qualified him as disabled under the on-occupation definition of disability under his STD coverage. The plan provides a benefit equal to 70% of salary, so Myron will receive disability payments of $2,800 a month, $4,000 times 70%, for up to 12 months or until he returns to work, whichever comes first. If Myron is still disabled after 12 months, his coverage will change from short-term disability to long-term disability. STD plans insuring lower-paid workers often coordinate with employment insurance, EI, so that the insured receives the benefits of I or STD during their benefit period. E is often a second payer of disability coverage. The following way of staggering EI and STD benefits ensures that this dollar-for-dollar reduction of EI benefits is avoided. I insurance has a 14-day waiting period and 15-week benefit period. When disability begins, the insured receives the STD benefit during the first 2-week waiting period of I. When the I benefit period initiates, the insured stops receiving STD benefits and begins receiving I benefits for a total of 15 weeks and then stops. The insured begins receiving the STD benefits when the EI payments stop. Long-term disability, LTD. LTD begins when STD ends and the plan member is still disabled. The STD benefit can be thought of as the waiting period for the LTD benefit. The insurance is structured with a benefit payment of 50 to 60% of earned income, lower than STD. A benefit period of 2 years, 5 years, 10 years or to age 65. An own-occupation definition of disability for the first 12 months of benefits. And any occupation definition of disability after the first 12 months. Example continued. After 12 months Myron's leg still had not healed enough for him to return to his regular occupation as a mobile supervisor. He remained on disability claim, but now under the long-term disability coverage from the group plan. His monthly benefit was reduced from 70% to 60% of salary, from $2,800 a month to $2,400 a month. Myron's qualifying definition for disability would last for another 12 months, if the disability lasts that long, but will change to an any occupation definition at the end of month 24. By that time, Myron would be expected to take up another suitable occupation within the company, if possible. If a suitable alternative was available to him and he failed to take advantage of it, his benefits would stop. If he was unable to perform the duties of another suitable occupation, his benefits could continue for up to 3 more years, completing the 5-year benefit period that his group plan provides for a combined STD or LTD claim. Leave of absence. A leave of absence is either paid or unpaid and refers to a period of time when the employee is away from work for any reason supported by the employer. The following are a few examples of leave of absence. To care of a terminally ill family member. To conduct independent research. Teachers may take their 4/5, which refers to a voluntary arrangement when they earn 80% of their salary for 4 years and take a sabbatical 5th year off, still earning 80% of their salary. There is no consistent treatment for premiums or benefits if an employee, that is, a group plan member, becomes disabled during a leave of absence. For example, some plans do not offer coverage if the insured becomes disabled during a leave of absence, whereas others will provide coverage only if the group premiums are still being paid on a monthly basis. In most cases, the employee has to pay the premiums during his leave of absence. The insured must consult the group plan's master contract to see if he is covered during a leave of absence. Plan enrollment and membership. The group administrator enrolls new members, administers claims, removes ex-employees, and maintains all necessary records. Qualification period. The qualification period is the period of time between starting a job with a new employer and being able to enroll in a group plan. Most groups' DI plans require a qualification period for new employees. It is often linked with the initial 30 to 90 days of employment, the probationary period when the employee can be fired without recourse. For example, Anthony begins work with AMF Resources on July 1st. The AMF Group Insurance Plan specifies a 90-day qualification period. By the end of September, Anthony has qualified to join the plan and AMF enrolls him. Premium payment. In a non-participating Group DI plan, or non-par plan, the employer pays the total premium monthly on behalf of all employees. The employer pays for all of the coverage, the employees did not contribute. In a participating Group DI plan, the employees contribute to the premium. The sum is collected from each employee by payroll deduction. The employer makes the premium payment, which is a combination of the employee contributions and employer contributions. Association group plans usually pay their premium by direct withdrawal from a bank account. Terminating membership. Membership in a group plan may be terminated by an cancellation of the master contract by the employer or the insurance company. Employee ceasing to be an employee of the company. Employee failing to meet membership requirements, that is, a reduction in weekly employment hours below the policy's weekly minimum amount of hours. Employee or group plan member retirement. The member may have a right to conversion of the group policy to an individual policy without having to provide medical evidence of insurability within 30 days of termination of membership in the group plan, usually subject to certain restrictions. This right to conversion is universal with group life insurance coverage but may also apply to DI coverage. Amount of benefit. Group plan members will find the amount of disability benefit they receive is limited to 1. Non-evidence maximum, the maximum benefit stated in the master contract regardless of the plan member's income. 2. Maximum overall, this additional benefit is based on a percentage of the group member's income. 3. All sources maximum, the maximum benefit from all sources stated in the master contract and set out by the group offset rules. Diagram 2.4 demonstrates the relationship between the different types of benefit amounts. Non-evidence maximum coverage. The non-evidence maximum coverage is in place to ensure that all group members receive a base level of benefits regardless of their income and health. No medical underwriting is required. This basic coverage is set in place taking into account the insurer's risk and plan sponsor's costs. Maximum overall coverage. The maximum overall coverage is in place for plan members who would like additional coverage on top of the basic non-evidence plan coverage. The maximum overall coverage has two main limits. 1. Plan members must qualify financially for the additional coverage. 2. Plan member must also undergo medical underwriting and fully pay for such additional coverage. The maximum monthly benefit is stated in the master group plan. Maximum monthly benefits are often tied to group size. Larger groups offer larger maximum monthly benefits whereas smaller groups offer a smaller amount. The maximum coverage a plan member will receive is based on whichever amount is less, the group plan maximum or a percentage of his income. The employer or employee can also take out coverage that is less than the maximum amount stated in the master contract. Example. Chiang and An are members of the same employer group DI program which provides for maximum long-term disability coverage of 60% of salary, or $5,000 a month, whichever is less. Chiang, who earns $90,000 a year, qualifies for a maximum benefit of $4,500 a month, $90,000 times 60%, divided by 12. Eng, who earns $120,000 a year, is restricted to the maximum monthly benefit of $5,000, despite the fact that his income could qualify him for $6,000 monthly benefit, $120,000 times 60%, divided by 12. Benefits can either be treated as taxable or non-taxable income. The percentage of earnings considered in setting the overall maximum coverage will depend on how the benefits are taxed. STD benefits are taxable and are usually in the higher percentage range, between 70 and 75% of pre-disability income. LTD benefits are generally non-taxable and are usually in the higher percentage range, between 60% to 66.66% of pre-disability income. Example: Brandy works for a company that offers group DI coverage. The non-evidence maximum amount of LTD coverage is 50% of salary and the maximum benefit is set at 66.66% of salary, to a maximum of $10,000 a month. Brandy earns $90,000 a year and has elected to take full coverage of $60,000, 66.66% of $90,000 minus $5,000 a month. The first $45,000 of annual coverage, 50% of salary, would be provided on a non-evidence basis, but Brandy would have to qualify medically to add the additional $15,000 of coverage, 16.66% of salary. Group Offset Amendment. The all sources maximum is in place to ensure that the employee still has an incentive to return to work. If the disabled individual receives benefits that match or exceed his pre-disability income, he will not have a monetary incentive to return to work. The Group Offset Amendment is stated in the Group Master Contract. It indicates the all sources maximum, in other words, the maximum in benefits available from all sources, direct and indirect. Direct sources are plans that pay monetary benefits directly to the disabled member, such as CPP or QPP, employment insurance, workers' compensation, auto insurance, disability benefits, association or other group benefits. Indirect sources are benefits paid to dependent spouses and children of the disabled life insured, such as children's benefit paid by CPP. An individually owned policy does not usually contribute to the all sources maximum, but such a policy may have its own offset rules. The maximum that can be received from all sources is 85% of pre-disability income. If the maximum will be exceeded by a benefit or combination of benefits, the group plan benefit will be reduced to respect the 85% limit. Example: Mr. Lee earns $60,000 a year as a plumber. He is employed with a company that provides an LTD benefit equal to 66.67% of its employees' regular, pre-disability income, or $3,333 a month. $60,000 times 66.67%, divided by 12. In the event of disability, Mr. Lee could also qualify for benefits of $1,020 a month from a personal policy, for a total of $4,353 a month of benefits. This would represent benefits of $52,236 a year, or 87.1% of his regular income. The 87.1% exceeds the 85% all sources maximum specified in the group plan's master contract, so Mr. Lee's monthly benefit from the group plan would be offset by $103 a month, $4,353 minus 85% times $60,000 divided by 12, to an amount of $3,230. Bringing the total monthly benefit from all sources to $4,250, or 85% of his pre-disability income level. Denial of benefits. Benefits will be denied for the same reasons benefits from a personal policy will be denied. See Section 2.2. Once a group member is no longer a member of the group DI benefits will cease. Taxation of group disability insurance benefits. STD and LTD benefits received by the employee are taxable income when the employer pays the premium. The premium is a deductible expense for the employer. However, if the group member pays 100% of the LTD premium, the benefit is received by the employee tax-free. The premium is not a tax-deductible expense for the employee. If both the employer and group member contribute to the LTD premium, the benefit received by the employee, up to his total amount of premium contribution, is tax-free. Benefits greater than premiums paid are taxable income. The premium contribution by the employer is a deductible expense. The premium contribution by the employee is not a deductible expense. Example: Maddie is a member of a group DI plan where the employer and the employee share the premium cost for all group benefits on a 50-50 basis. Up until now, Maddie has never made a claim against the LTD benefits available under the plan. However, this year he was injured and ended up receiving a total of $17,000 in group LTD benefits. To date, Maddie and his employer had shared the $8,200 in total premium paid on his behalf for the LTD coverage. For tax purposes, $4,100 of Maddie's benefits, his 50% of the $8,200 of total premiums paid, would be a tax-free refund of premiums, and the other $12,900, $17,000 minus $4,100, would be treated as taxable income. Table 2.3 illustrates a summary of the tax consequences to the recipient of benefits, based on the person or entity that pays the premiums for the disability coverage. Table 2.3. Taxation of disability insurance premiums and benefits based on payer. Personally owned policy. Payer. Policyholder. Deductibility of premium by payer. No. Tax status of benefits. Tax-free. Group policy. Payer. Employer only. Deductibility of premium by payer. Yes. Tax status of benefits. Taxable. Group policy. Payer. Employee only. Deductibility of premium by payer. No. Tax status of benefits. Tax-free. Group policy. Payer. Employer and employee. Deductibility of premium by payer. Portion paid by employer. Yes. Portion paid by employee. No. Tax status of benefits. Taxable with employee premiums reducing amount taxable. Integrating a group policy with an individual policy. Clients can rely on both group and individual insurance simultaneously in order to meet their needs. An individual may choose to supplement the benefit amount or improve the benefit period of a group policy with an individual policy. Benefit amount. A person who is covered by a group policy may find its benefit inadequate for his financial needs. Typically, LTD coverage is 70 to 75% and STD coverage is 60 to 66.66% of pre-disability income. He could take out a personal disability income policy with an extended benefit to reach a level of benefit more suitable to his circumstances. The individual DI policy would have the same definition of disability as well as the same benefit and waiting period as the group DI plan. The 85% all sources maximum must be respected. Benefits are paid first by the individual policy. It is known as the first payer. Then the balance of the total benefit to be received is paid by the group plan. Example: Andre's group policy offers LTD coverage of 60% of his $80,000 annual salary, or $4,000 a month of benefits, $80,000 times 60% divided by 12. He would be more comfortable with a 75% benefit level, or $5,000 a month, $80,000 times 75% divided by 12. He could supplement his group coverage by taking out an individual DI policy paying $1,000 a month of disability benefit, but otherwise on the same basis as the group plan. Benefit period. A group benefit period can be extended by an individual policy. The insured purchases an individual DI policy with the same definition of disability and benefits as the group plan but with an extended benefit period. The waiting period of the individual policy would become the benefit period of the group policy. Example: Amir has a group policy with a 60-day waiting period and a 2-year benefit period, a total of 26 months. He applies for a policy with a 26-month waiting period and a 5-year benefit period. The long waiting period reduces the premium for his personal policy. 2.4. Creditor disability insurance, and other providers. Creditors who belong to the same financial institution represent another group association classification. Lenders, that is, credit unions, banks, etc., will often collaborate with a life insurance company to provide Group DI coverage to protect debtors in the case of a disability. The DI insurance will make the scheduled payments towards the debt when the debtor cannot earn an income and is disabled. Creditor disability insurance is often provided as a package deal and is included with the loan itself. Benefits are received by the creditor tax-free. The premium for a creditor disability insurance policy is not tax-deductible unless the loan has been taken for the purpose of earning income from a business or property. Creditor disability insurance uses the total disability definition, that is, the inability to earn income due to an illness or an injury. Typically, no medical underwriting is done at the time of the application. However, at the time of the claim, the insured may be retroactively underwritten. There is a waiting period, generally 60 days. Policy premiums and the monthly loan payments are combined. The benefits are thus debited to the account that provides the loan payment. Amount of benefit. Group creditor DI benefits are connected to the insured's agreement to make monthly payments towards the unpaid balance of the insured's loan. Generally, the benefit is calculated as a percentage of the remaining balance, taking into account the maximum allowable monthly and overall limit. Example: a bank offers mortgage disability insurance that will pay a maximum benefit equal to the monthly principal and interest payments on the mortgage, to a maximum of $3,000 a month for 24 months. It also offers credit card coverage with a maximum benefit of the lesser of 3% of the balance and $600 a month, capped at an overall limit of $20,000. Taxation of creditor disability insurance benefits. The tax treatment of group creditor DI premiums is easy to grasp, receiving the same tax treatment as individual disability insurance. Personal premiums paid are a non-deductible expense. However, the premiums paid are a deductible expense if they are business-related, that is, a business or investment loan. Benefits are received and paid to the creditor on the debtor's behalf tax-free. 2.5. How they compare. There are similarities, differences, advantages and disadvantages to the three different categories of disability protection: individual, group and creditor insurance. Table 2.4 summarizes, compares and contrasts these characteristics. For characteristics of individual, group and creditor income protection, see Table 2.4. Chapter 3, Insurance to Protect Assets. 3.1. Critical illness insurance. Severe illness has a great impact on an individual's life and is certain, even if the injured is able to return back to work, to cause additional health-related costs or changes in lifestyle not covered by traditional disability insurance. Due to their medical condition, these individuals often need to acquire the financial means to make important changes in their lifestyle. Paying off debt, that is, mortgages or credit card balances, to assist with the financial stress associated with a long recovery period, medical expenses and/or reduced future earning ability. Alternative and conventional treatments not covered by provincial medical plans. Home renovations to accommodate changes in the individual's physical ability, that is, installing a wheelchair ramp. Choice to work part-time or change employment altogether, that is, due to reduced physical capacity. Vacations to deal with and reduce medical stress. Without CI benefits, the incurred expense of making these essential lifestyle changes could potentially greatly diminish one's assets. Furthermore, more individuals survive life-threatening conditions due to advancements in general medical care and, specifically, emergency medical treatment. For example, 1 out of every 2 Canadians who suffer a heart attack is younger than 65 years, 95% survive their first attack. 1 out of 3 Canadians will develop cancer, 65% of them will survive for a minimum of 5 years. 1 out of 20 Canadians who suffer a stroke are younger than age 70 and 75% of those will survive. Between 3% and 5% of critical illness claims are made by Canadians who had coronary bypass surgery. CI provides individuals within this group with the financial means to cover the additional health-related costs incurred and protect their assets. In other words, an individual insured with CI does not need to worry about depleting investments and savings to pay for health-related expenses and lifestyle changes. Coverage provided. The lump sum payment of a CI policy is received by the insured when he suffers from a medical condition covered by the CI contract. Minimum or maximum issue ages. Typically, a policy may be issued to those between 18 and 65 years of age. Insurers typically do not accept individuals over the age of 65 due to the high risk they pose. More limited policies are available for children. These plans offer significantly lower benefits. Minimum or maximum face amount. Minimum coverage is $10,000, maximum is $2 million. Typical policy face amounts are $50,000 to $500,000 and differ by insurers. The amount of coverage issued will be based on an applicant's age, gender, smoking status, medical history and current health, medical history of parents and siblings, financial status relative to the amount of insurance, that is, to avoid overinsurance. Qualification period. There is a 30-day qualification period following the issue of the policy during which the benefit cannot be claimed. Survival, waiting, period. It is important to understand the differences between CI policies and life insurance. CI benefits are contingent on the insured contracting a covered medical condition and surviving, opposed to life insurance benefits which depend upon the insured dying. The insured must survive at least 30 days after the diagnosis in order to receive the benefit. There is a 30-day qualification period during which benefits will not be paid if a diagnosis occurs within the first 30-day period of a newly issued policy. Thus, for a newly issued policy, a 60-day period will most often be in effect before benefits will be payable. Insurance companies differ in their requirements for the qualification and survival periods. 30 days qualification and 30 days survival is the minimum. Duration of coverage. CI is issued with both term and permanent forms of coverage. Term policies are issued for a period of years, such as 10 years or 20 years, or to a specific age, such as age 65. The 10-year and 20-year contracts are often guaranteed renewable to age 75 with an increase in premium. They may be convertible up to age 65 to permanent coverage without medical evidence, but the insured may not be on a claim at the time of conversion. A permanent policy ends at age 100. All policies are terminated by a claim unless a rider covers a second event as described in this section. Types of policies. Policies are issued based on the number of conditions they cover. Base policies cover 3 to 4 major health conditions. 3 health condition policies cover heart attack, stroke and cancer. 4 health condition policies cover the above plus coronary bypass surgery. Extended policies cover 10 to 20 health conditions including the above conditions, outlined below under conditions covered. CI policies for children cover conditions specific to the young such as cystic fibrosis, muscular dystrophy, type 1 diabetes and cerebral palsy. A child policy may be convertible to adult coverage when the child reaches the conversion age set in the policy, such as age 18 or 25. CI insurance is also offered by financial institutions for coverage of a mortgage. Issued with minimal underwriting potential underwriting when claim occurs. In place to discharge the remaining mortgage balance if the mortgage payer suffers a critical illness. Benefits paid directly to the financial institution. As a rider on a life policy. Limited benefits. Through certain standalone mortgage life and disability policies also contain a clause for payout of a benefit in the event that the insured should suffer a critical illness. Through guaranteed issue contracts. Without underwriting. A declaration of good health is required. More expensive than coverage that is underwritten. Limited benefits to less than $100,000. Conditions covered. Policies vary in their coverage by insurer. Some conditions are excluded from coverage, such as non-occupational HIV or AIDS. Definitions of covered medical conditions may vary from between plans. Often the definition of covered condition may vary from plan to plan. For example, the degree of heart muscle damage may determine if the insured's heart attack was severe enough to be covered under the contract's definition of a heart attack. Big Four: heart attack, stroke, cancer, and coronary bypass surgery. Most basic CI policies provide coverage for what is called the Big Four: heart attack, stroke, cancer, coronary bypass surgery. Expanded coverage. The list of conditions covered may be expanded to more comprehensive policies which cover 10 or 20 conditions, depending on the insurance company. The additional benefits are often added onto the CI contracts as a rider. List of conditions covered and which riders can be added differs between CI carriers. The more conditions covered, the higher the premium. The insurer takes on a greater risk of paying a benefit. Definitions differ between policies. See table in section 3.1 for potential coverage offered. The more conditions that a policy covers, and the easier it is to meet the definitions of those conditions, the more at risk the insurer is of having to pay a claim. And hence, the higher the policy premiums will be. The exact definition of these conditions may vary from policy to policy. Most conditions must be severe enough to be life-threatening before benefits would be payable. Riders available. The two most common CI policy riders are the following. The return of premium rider, also referred to as the refund of premium rider. Waiver of premium rider. Return of premium. The return of premium rider added to the CI policy refunds all or some of the premiums paid by the policyholder upon death or expiration of the policy provided there has never been a claim. The following returns of premiums can be offered. On death, a total or partial refund is paid to the policyholder's estate or named beneficiary if the insured dies from a condition not covered by the policy or dies during the qualification and survival period. On surrender, a total or partial refund is paid if the policyholder cancels the policy after a specified number of years without a claim. On maturity, a total or partial refund is paid if the policy matures at the end of its terms, that is, at the end of its term, without a claim. Waiver of premium. The waiver of premium rider added to the CI policy comes into effect if the insured becomes disabled. The waiver of premium rider waives all premiums for the period of disability. The qualifying disability for a waiver of premium is different than the qualifying disability under the CI policy, that is, a claim that would result in CI benefits. For example, a minor stroke that is temporarily debilitating would trigger the waiver of premium, whereas a severe stroke that causes long-term damage would trigger the CI benefits. The rider is added when the policy is issued. To qualify for the rider, the insured must meet certain medical qualifications, pay additional premiums for the rider, be under the age of 55. A waiting period of 4 to 6 months is in place after the beginning of the qualifying disability. The premiums paid by the insured during this time may be refunded to him upon expiration of the waiting period. The waiver continues until disability ends. A successful claim is made for the CI benefit, or the policy expires. Payment of benefits. Benefits are paid when the diagnosis and beginning of the condition must occur a minimum of 30 days after the policy's issue date, that is, after the qualification period. The life insured must survive the diagnosis and be alive at least 30 days after diagnosis, or more as specified in the policy. The insured dies after the waiting period but before the claim is paid, the benefits would be payable to their estate or beneficiary. The life insured has to typically file a claim within 30 days of his qualifying condition's diagnosis. Medical proof has been provided within 90 days of the claim. The life insurance medical advisors must also approve the claim in terms of the CI policy requirements. Although the lump sum form of payment is most common, some policies provide installment payments. The benefit payout is a one-time payout. After a successful claim, the policy is cancelled. Example: Sylvia successfully claimed a $100,000 benefit under her CI insurance policy in 2011, due to the diagnosis of a qualifying cancer. When she subsequently had a heart attack in 2013, she was unable to make a second claim under her policy because the contract had been terminated upon payout of the 2011 cancer claim. The exception to this is when there is a second event rider that will continue to provide a lesser amount of benefits after claim 1 upon a future unrelated claim. For example, if the insured has a second event rider and files a first claim due to a heart attack, his second claim related to life-threatening cancer will issue a second, lesser benefit payment. There are standard exclusions to the payment of the benefit. They include a medical condition arising from war, terrorism, attempted suicide, self-inflicted wounds, normal pregnancy, criminal activities, drug abuse, non-occupational AIDS or HIV, tax treatment of critical illness premiums, benefits and return of premium benefit. Premiums paid are not tax deductible. Premium paid did not qualify for the medical expense tax credit. Benefits received from a claim or return of premium are tax-free. 3.2. Long-term care. More Canadians are living longer and some will need care for longer periods of time. Long-term care is much more than nursing home care. Home care, assisted living facilities and nursing home care are all examples of long-term care. Anybody who cannot take care of their physical needs on an independent basis may qualify for long-term care. A young person suffering from multiple sclerosis, an individual suffering from a brain or spinal cord injury that has left them with severe physical and mental problems, as well as an individual with Alzheimer's are all examples of individuals who qualify for long-term care. This chapter looks at the insured's need for long-term care, the types of care available and the insurance coverage in place to assist with long-term care expenses. Canadian demographics. The majority of long-term care users are over the age of 65 in Canada. This demographic will greatly expand over the next 20 to 30 years as the baby boomers age. See Diagram 3.1 for age of male and female Canadians between 1956 and 2056. Diagram 3.1 demonstrates the following. The age and gender structure of Canada's population has changed significantly between 1956 and 2056. By the mid-20th century, the large number of young people caused the population distribution to be pyramidal. By 2006, the population distribution shows a large bulge in the age structure primarily due to the large cohorts of the baby boomers. The above changes reflect the aging population over the past 50 years, where the median age changed from 27.2 to 39.8 between 1956 and 2056 and is expected to reach 46.9 by 2056, 20 years more than it was in 1956. By 2015, it is estimated that seniors will outnumber children, and by 2050, it is anticipated that seniors will outnumber children 2 to 1. In terms of government financial support to assist a large number of seniors, this creates a potential problem due to fewer people entering the workforce, and thus fewer people paying taxes, and more people aging and in future need of long-term care assistance. Who is going to provide the financial support for the future need of long-term care assistance? LTC could potentially be part of the solution to pay for the future funding of long-term care. Long-term care options. Long-term care is available in public and private facilities. Expense ranges from lower cost, publicly provided, options to very expensive, well-equipped private facilities. The most common private or public services available are home care, respite care, assisted living, nursing home, facility, care. Home care. Care provided at home is the first step in the process of long-term care. Often the first choice for many seniors. It is ideal to stay in the home environment for as long as possible. Home care provides quality of life. Home care can be provided by a healthcare worker, community service work or caregiver. Home care is most often provided by a primary informal caregiver such as a family member when the patient's need is minimal. Home care services are generally charged at an hourly rate and may or may not be necessary on a daily basis and are likely to be a temporary need. Home care is provided as nursing, daytime companionship and overnight stays, help with meals or housekeeping, and personal care for bathing and other activities of daily living. Respite care. An individual who requires full-time care at home can become a burden both physically and emotionally over time to his at-home caregivers who is normally a member of the patient's family, spouse, child, grandchild, etc. Respite care provides relief by giving the caregiver a break. The caregiver is provided with relief through either informal assistance for a short period of time from friends, family and community services, or formal assistance adult day care or a nursing home stay. The caregiver is temporarily released from caregiving responsibilities, that is, for an overnight stay or longer. Generally, informal assistance is free whereas formal assistance comes at a cost, that is, the cost of adult day care, transportation, etc. Example. Rudy, age 62, looks after his 86-year-old mother, who has Parkinson's disease, on an essentially full-time basis. She lives with Rudy and he has to assist her with many day-to-day activities and keep a watchful eye on her to prevent her from accidentally injuring herself. Although Rudy has nurses and care workers coming to his home to offer his mother regular therapy and assistance, the situation is still very wearing on him. Respite care would provide for Rudy's mother to spend a few days each quarter in a temporary stay at a nursing home facility, to give Rudy a much-needed break from the stresses of the day-to-day care routine. Assisted living. Assisted living facilities, often referred to as seniors' residences, are provided to those who can no longer function in an independent living situation or in their homes but do not require 24-hour medical care or supervision. The middle degree of care between home care and nursing home care. Part-time nursing support may be available in addition to assistance with daily activities, such as shopping or cleaning. Nursing home, facility, care. Nursing home care is a preferred solution for those who can no longer live independently and require continuous assistance and medical attention. Nursing homes have a doctor on site and provide 24-hour-a-day care such as assistance with daily living. Their in-house facilities typically offer assistance with the activities of daily living, fully prepared meals, and group and individual recreation activities for their more active members. Some nursing homes schedule field trips for their more active members. Providers of long-term care. Long-term care services are provided through government facilities, religious organizations, not-for-profit organizations, and for-profit corporations, that is, private service providers, assisted living centers and nursing homes. Publicly funded facilities. Provincial governments regulate and fund public nursing homes at subsidized rates for low-income patients who are unable to afford the full monthly fees. Care is subsidized by the provincial health care plan based on a means test provided to low-income individuals. Publicly funded home care. Home care costs may be funded by the government through a contracted agency, a subsidy to an individual who has selected his own home caregiver through a home care agency. For additional information regarding home care funding, refer to Evidence and Perspective on Funding Healthcare in Canada at healthcarefunding.ca web link. Cost of long-term care. It is typically expensive to stay in a nursing home and the cost depends on a number of factors. Whether the patient has a shared or private room. Whether the facility is public or private. Private nursing homes are significantly more expensive than public. Where the patient lives, costs are higher in some provinces than others. The insurer takes on additional risk based on the amount of coverage the province covers. Whether the care is basic or extensive. A patient may live for many years in a nursing home. The cost can become substantial over time and deplete the insured's estate. It is important to remember that some private nursing homes offer additional services and may charge much more than the norm. In most provinces, provincial subsidies are means-based. Higher income individuals receive a much lower subsidy and pay for more costs independently. In these cases, there is a large gap between what the province covers and the actual cost of care the patient must pay. LTC insurance is in place to relieve the insured's financial burden of long-term care, and pay for the long-term care facilities the insured needs rather than just what they can afford out of pocket. See Table 3.1, which is a representative example of average monthly costs of a full-time resident in a nursing home among the different Canadian provinces. 3.3. Individual Long-Term Care Insurance, LTC. A long-term care insurance policy provides a maximum daily benefit to the insured who is no longer able to function independently due to illness, injury or aging. This benefit covers the insured's expenses related to professional health care services. The insurance is available as a standalone policy, most common, a rider on a life insurance policy, a rider on a critical illness insurance policy. LTC riders are added at the time of the base contract's application. Subject to underwriting, both medical and financial. Subject to its own additional premium. Long-term care benefits are paid directly to the patient to reimburse expenses already paid, reimbursement model. The service provider such as a nursing home, indemnity model. Purpose or who needs it. As lifespans lengthen and government financial resources become ever more strapped, it is suggested that all Canadians need to acquire long-term care insurance to be able to personally fund the need for care in their elder years. For example, in 2011, almost 5 million Canadians were over 65 years of age. 7% of individuals over 65 and 30% of individuals over 85 lived in care facilities. For additional information refer to 2011 Census of Population, Families, Households, Marital Status, Structural Type of Dwelling, Collectives. Go to Statistics Canada's website. Individual LTC insurance is available as an additional rider to life insurance policies or on a standalone basis. Insurance is best acquired between 45 and 55 when premiums are lower. Coverage is typically not available after age 65. Advantages. The primary advantage of long-term care insurance is the funding it provides to the insured in order to receive the desired type of care without worrying about the expense of long-term care services, whether that means a longer period of independent living with home care or the luxury of a top-notch nursing home. LTC also retains estate value by paying the expenses of care. Without LTC insurance, the insured would most often experience depletion in their estate value when paying for care services. Therefore, LTC insurance typically results in a better quality of life due to the better quality of services he receives through the LTC insurance without the added financial stress of either paying for these services out of pocket or depending on the government for care in retirement. Coverage provided. LTC policies provide coverage for insureds who, due to old age, injury or illness are in need of in-home care, assisted living facilities and respite benefits as an alternative or in addition to care facilities. LTC policies cover many of the expenses not covered at all or not fully covered by provincial health plans. An applicant is subject to medical underwriting based on age, gender, and smoking status. Medical history. Current health and cognitive ability. Ability to perform 6 activities of daily living. A policy provides a maximum daily benefit and a total number of days the benefit will be paid, to an overall maximum. The daily limit may not be exceeded. However, if less than the maximum is spent in any one day, it can be used to add more days to the total number of days of coverage. There is an elimination period of up to 90 days, based on the amount of days of care the insured can afford to fund independently. The longer the elimination period, the lower the premium. Standard exclusions apply for illness, injury, or an impairment arising from war, terrorism, attempted suicide, etc. Example. Gregory has an LTC insurance policy with a rider that offers him up to 1 year, 365 days, of home care coverage at a maximum of $200 a day. His overall maximum benefit for home care would be $73,000 or $200 times 365 days. If some of his care days required less than $200 of benefits, the term of the benefits payable could be extended beyond 365 days until the entire $73,000 of benefits had been paid out. Activities of daily living, ADLs. The ability to perform the activities of daily living, ADLs, is fundamental to a long-term care policy. Activities of daily living, ADLs, are a measure of physical ability. To receive a benefit, the insured must not be able to independently perform any two or more of the following ADLs. Dressing, the ability to dress oneself. Bathing, the ability to wash oneself. Toileting, the ability to get on and off, and to and from, the toilet. Transferring, the ability to move from one location to another without the use of a supporting device, that is, from a chair to a bed without the relying on crutches. Eating, the ability to feed oneself. Maintaining continence, the ability to maintain control of one's bowels and bladders. Cognitive ability is another test applied to determine whether the insured qualifies for benefits. Cognitive abilities relate to the mental processes of perception, memory, judgment, and reasoning. Its absence is called cognitive impairment. Cognitive impairment can be created by an underlying physical condition, such as a stroke, or mental condition, such as Alzheimer's disease. A physician attests to ADLs and cognitive impairment. This physician is often chosen by the insurance company. Long-term care riders available. Although there will, of course, be exceptions in the marketplace, the following are the most common riders available under long-term care contracts. Cost of living adjustment, COLA. Return of premium. Cost of living adjustment, COLA. By the very nature of the insurance provided, the benefits from an LTC policy could be paid for many years. Due to inflation, the maximum daily benefit could potentially not cover the rising costs of care over time. The COLA rider will ensure purchasing power is not eroded over time by automatically increasing the maximum benefit by 2% to 3% per year. This ensures that the benefits stay in line with the rising costs of care. Return of premium. A premium refund is possible if this rider has been purchased, and the insured dies before a claim is made. The refunded amount varies between policies with a maximum of 50% of premiums paid for a 10-year duration or 100% for a 20-year period. The rider adds 25% to 50% to the basic policy premium. Benefits are tax-free. Example. Antonia paid $1,800 a year for her LTC insurance policy, including a $400 extra annual premium for a return of premium rider providing for a 25% refund of total premiums paid over an 8-year claim-free period. She died this year after having paid into the policy and been claims-free for 10 years. Upon her death, her estate received a $4,500, 25% times $1,800 times 10, return of premium benefit from the insurance company. Policy benefits. The long-term care insurance policy daily benefit may be paid to the patient for reimbursement of personal expenses. The service provider, such as a nursing home, referred to as an indemnity benefit. Benefits are subject to an overall limit defined in the contract. Typically, home care benefits are reimbursed to the insured whereas nursing home care benefits are paid to the nursing home. The insured must provide the insurer with receipts in order to be reimbursed. The insured is reimbursed only for the amount spent on care, not the total maximum daily amount. Maximum overall benefit is calculated by number of days of coverage at the maximum daily rate. Benefits begin when the attending physician certifies the need for services and the services begin. Example. Kashif, age 71, suffered a stroke 18 months ago that resulted in limited mobility. Consequently, he was restricted to his home most of the time and had to have nurses, a physiotherapist and a housekeeper attend him regularly. cash if paid for these services himself and then claimed a reimbursement from the home care clause under his LTC insurance policy. Unfortunately, cash if suffered a second stroke 3 months ago and is now confined to a nursing care home full-time. Costs not covered by the provincial health care plan are now paid directly to the nursing home under the indemnity benefit provided by cash if's policy. Tax treatment of long-term care benefits. All benefits paid out under a long-term care policy are tax-free to the insured, whether those benefits are paid directly to the caregiver or care facility involved in providing care or to the insured by way of reimbursement for services previously paid personally. Premiums. Premium payments may be required for the total duration of the contract, with the exception for when the policyholder is on claim and receiving benefits, or a fixed-term option for premiums, such as 20 years. This typically will allow the insured to pay for his policy before retiring. Typically, policies are guaranteed renewable and thus renewed annually. However, the majority of policies have a provision that states that premiums may be raised at renewal by the insurer's discretion on a class basis. There is a 30-day grace period following the premium due date that keeps the policy in force if the premium is not paid on time. The policy lapses when the grace period ends and the premium has not been paid. The premium payable amount is contingent on the following factors: amount of coverage, number of days benefits are payable, type of coverage, elimination period, the insured's underwriting characteristics, requirement to qualify for benefits, tax treatment of long-term care premiums. Premiums are not tax deductible. They may qualify as eligible expenses for purposes of claiming the federal medical expense tax credit. 3.4. Coordinating long-term care insurance, LTC, with other types of accident and sickness insurance, disability income insurance, critical illness insurance, and long-term care insurance possess distinct as well as similar characteristics. Each form of insurance fills very separate roles as a result of the characteristics outlined in Table 3.2. For characteristics of disability insurance, critical illness insurance and long-term care insurance, see Table 3.2. Long-term care insurance, LTC, and disability insurance. There is no duplication of benefits between these two policies because DI policies replace lost income in the event of disability. They do not cover the additional costs incurred due to disability. LTC policies cover incurred health care costs and related expenses. They do not replace the insured's income. However, up to a certain age of the insured, some insurers allow DI policies to be converted to LTC policies. Long-term care insurance, LTC, and critical illness insurance. Benefits could be duplicated with an insured receiving the benefit of each. This duplication is almost unavoidable because CI policies provide the insured with the financial means to adapt to the costs of life changes from an outlined cause, that is, a heart attack. Based on the consequences of his condition, the insured may or may not qualify for all the services in the LTC policy, that is, a nursing home. Even so, the cash would be provided by the critical illness plan. Therefore, it is difficult to build an offsets between CI and LTC policies. 3.5. Limitations of critical illness insurance, CI, and long-term care insurance, LTC. Insurance coverage does not always guarantee that the insured's total medical and care needs will be covered in the event of an accident. Gaps do exist between the insured's need, the policy's coverage as well as the benefits available. All contracts should be read carefully before finalizing an application. Particular attention should be paid to the importance of contract wording. It is very important to examine the contract closely and never make an assumption that the insured's coverage needs will be met. For example, the benefits start date will be worded in the contract. Benefits will only be payable to the insured after this date. The importance of definitions. Coverage definitions are a major factor in determining if an individual qualifies for benefits. The insured will not receive his benefits unless his condition matches the exact definition outlined in the contract. For example, a degree of cognitive impairment will be defined in the contract in order to qualify for benefits. Over time, the insurer's definitions of benefits change. Therefore, based on when the contract was issued, the same insurer may vary their definition of a given condition. Differing medical opinions from the insurance companies and the policyholder's medical advisors. The insurer's medical specialists set out the criteria for coverage and if the insured qualifies for benefits, even if other doctors outside of the insurance company state that the insured qualifies for benefits. Chapter 4, Insurance to Protect Savings. 4.1. Types of extended health coverage to protect savings. Extended health coverage provides coverage for many medical expenses. Some expenses are continual, such as a recurring prescription. Others arise suddenly as a result of an accident or illness. All such costs can reduce cash flow available for savings or require an individual to dip into savings for payment or income needs. Extended health insurance reduces the risk of losing savings to healthcare expenses. A policy may be purchased directly from an agent. The policy owner is typically the person who makes claims and receives the policy benefits. Policies are available to individuals, as personal policies, and members of group plans. Extended health insurance is also offered by financial institutions, that is, banks, credit unions, etc., to their credit customers with limited coverage. This coverage is not common enough to be discussed in this chapter. Individual extended health insurance. Each provincial government provides health insurance to its residents. Provincial health care coverage includes many forms of medical care and treatment at home and within Canada. It also provides a reimbursement for a portion of medical expenses incurred outside Canada. An individual extended health insurance policy supplements the coverage provided by the provincial plan or group healthcare plan. The policyholder buys the plan directly from the insurance agent. The policyholder chooses the plan benefits and limits that best suit their needs and circumstances. The policy can be cancelled at any time. Group extended health insurance. Group plans provide coverage to many Canadians for extended health services. The coverage is provided as a predetermined range of services, with set limits and some options, such as additional family coverage. Group plans cover a group of individuals who typically share an occupation, association or employment in common. The majority of individuals who have extended health insurance are insured under a group plan through their work. The policyholder is typically an employer, the group members are the employees. 4.2. Types of extended health coverage to protect savings. Typically, individual extended health coverage options reflect those offered with group plans. Medical care, dental care, travel insurance. Individual policies permit that the insurer chooses one or more of these options to form a health plan in line with their personal needs. This is opposed to group policies which require that these options be compiled into a contract of predetermined benefits. Therefore, when choosing the individual extended health plan, both the types and level of coverage are left up to the individual in terms of their needs and finances. Full underwriting applies to policies except travel insurance. Travel policies apply underwriting when a claim is made. Medical care. Medical care coverage is provided to those who want to add coverage to their existing provincial health care insurance. New residents of Canada who have not yet qualified for their provincial health care insurance, and members of group plans who want to add coverage on top of their group plan and their existing provincial healthcare insurance. Coverage provided. Coverage for individuals is available for extended health care, for example, hospital services not covered by provincial health care insurance such as a semi-private or private hospital room. Accidental death and dismemberment, a D&D. Prescription drugs. Dental care. Vision care. Emergency travel medical. Again, The applicant can pick and choose what types and the amount of coverage to include in the contract in terms of their budget and needs. Some contractual restrictions put out by the insurance company do apply. Deductibles and coinsurance. Deductibles and coinsurance refer to provisions that require the insured to pay a portion of the covered medical expenses out of pocket. Their purpose is to reduce the premium cost by making the insured responsible for a portion of the qualifying costs, and discouraging the insured from making unnecessary claims due to their responsibility for a portion of the qualifying cost. They may apply to all forms of coverage as well as both individual and group plans. A deductible refers to a dollar cost that the insured must pay in full of otherwise covered benefits before insurance claims will be paid by the insurance company. A deductible is charged annually and restarts anew every year. A deductible is most common in a group plan. Example: Jose's plan has a $100 annual deductible for dental benefits. He must pay the first $100 of dental expenses annually himself, without reimbursement from his plan. Coinsurance refers to a cost expressed as a percentage that the insured pays on each claim. The insurance company pays the balance of the claim. Coinsurance limits the insured's coverage. Coinsurance is applied to every claim. Example: Consuela has purchased an individual extended health policy that has an 80% coinsurance factor for dental claims. The plan pays for 80% of each claim and Consuela assumes responsibility for the other 20%. Dental care. Dental care is not generally provided by provincial health plans. Therefore, dental care is often the backbone of the individual extended health coverage plan. Coverage provided. Dental insurance coverage is categorized as routine maintenance and major restorative services. Routine maintenance is just as its name describes, routine dental services to maintain healthy teeth. It includes regular checkups, periodic x-rays, cleaning, fillings, extractions. There is an annual maximum to what will be paid for routine services and often coinsurance that requires the insured to pay 20% to 25% of costs. Major restorative services include crowns, bridges, dentures and other major dental procedures. A much higher coinsurance factor applies to major restorative services. The insured may be required to pay as much as 50% of the cost. Claims for both categories are also limited to a fee schedule set provincially by each dental association. For example, if a provincial dental association has a schedule that specifies a filling costs $200, and an insured's claim for a filling is $250, the insured will need to pay the $50 in excess. $250 minus $200 equals $50. For extensive dental work, that is, in the $500 or more range, insurers generally require that the insured have the dentist submit an estimate before the dental work takes place in order to predetermine coverage cost. Example: Igor's dentist charges $300 for basic tooth extraction. The provincial dental schedule sets the price of a standard extraction at a maximum of $225. Igor will have to pay the difference of $75 himself since his dental coverage is restricted to the amount specified in the schedule. The policy's coinsurance factor will further increase the amount he must pay. Deductibles and coinsurance. Deductibles and coinsurance are also applied to dental insurance claims to regulate premiums for extended health coverage. Dental insurance uses the most amounts of deductibles and coinsurance services. This is because medical services are generally partially or fully paid by the provincial healthcare plans, whereas dental plans typically are not. This leaves the cost of the dental expenses up to the individual and insurance company to cover. Travel insurance. Travel insurance is a broad term that encompasses both emergency medical care needed when traveling and may cover some or all of the following. Emergency medical expenses. Costs for lost or damaged luggage. Trip cancellation. Return home of an ill or injured traveler. Medical expenses incurred abroad may be reimbursed by the provincial healthcare plan of the patient according to the schedule set by the provincial healthcare plan. Because provincial health coverage varies among the different provinces, an expense may be covered in one province but not another. The patient must be prepared to pay costs charged outside Canada personally and then file receipts with their provincial plan on their return. For example, if the AHCIP, Alberta Healthcare Plan, schedule is set at $175 for a visit to the office of a specialist in the U.S., and the cost paid by the patient is $375, the patient pays $375 and gets $175 from AHCIP. The uninsured patient is out of pocket $200. Travel insurance is particularly critical when traveling into the United States, where a hospital cost can cost upwards of $7,000 per day. This price is up to 20 times the price of a hospital stay in Canada and can be exceptionally draining to an individual's savings and cash flow if that individual is not insured. Travel insurance coverage is offered by travel agents, and directly from insurers, financial institutions, airlines and online providers. The insured must understand what is covered under their travel insurance policy, as different policies offer a wide range of services as well as level of coverage. Some jurisdictions do not require an insurance license to sell travel insurance. Medical underwriting is done when the claim is made, not at the issuance of the policy. Coverage provided by an insurer. Travel insurance can cover virtually all conceivable medical charges arising from an accident or illness. It does not cover elective procedures, such as cosmetic surgery. Coverages available include, among others, doctors' and nurses' fees, hospitalization costs, medical equipment, ambulance services, dental costs for accidental injury, return of the injured traveler to their province of residence, return of a deceased traveler remains to their province of residence, return of the insured's vehicle to their province of residence, lost baggage insurance, trip interruption or cancellation due to illness. The insurer often provides the insured with a contact card with the name and number of a provider to be contacted when an emergency occurs. The contact can assist the insured by ordering an ambulance for them as well as directing them to the nearest place where they can seek medical assistance, that is, a hospital, clinic, etc. Coverage provided through a credit card. Credit cards often provide travel medical coverage as an option or standard coverage that comes automatically with the card. Coverage from a credit card is typically not as comprehensive as coverage with an insurance policy. Coverage can differ greatly based on the provider and card type. Some require their card to be used to book the trip before providing medical coverage. For example, if Sally uses her MasterCard to book her trip, her Visa card medical coverage may not apply. There is no medical evidence of insurability required. When a claim is made, the insurer determines if the claim is covered under the terms of the coverage. However, a claim may be denied if it is discovered to be a pre-existing condition. Therefore, the insured is never completely sure if a claim will be honored under the travel insurance provided through a credit card. Pre-existing conditions. A pre-existing condition is a medical condition experienced by the insured up to 180 days before departure. It includes a visit to a doctor for specific symptoms needing treatment, medical tests or a prescription for medical tests, medical treatment for a condition or a prescription for medical treatment, a change to a prescription. This includes stopping the prescription, or decreasing dosage or frequency. In some cases, insureds failing to disclose to the insurer that they take a daily preventative baby aspirin against stroke or heart attack could lead to a denial of the claim, since this is viewed as not disclosing a pre-existing condition related to medication. Chronic conditions are health conditions that are long-lasting or recur frequently. Coverage may be restricted for chronic conditions if the individual has not had to see a doctor for the condition or experienced any symptoms for up to 1 year before the trip. A pre-existing condition does not necessarily mean coverage will not be provided for the condition. However, the condition must be revealed and the underwriter decides whether to manage the risk by exclusion or a higher premium. Example: Antonio, a resident of Quebec, scheduled a 30-day trip to his native Italy. Before his departure, he took out travel insurance through his local credit union. Antonio has been taking medication for epilepsy for the past 12 years, medication that does not always fully control his symptoms. If Antonio were to require treatment due to an epileptic seizure while in Italy, his treatment expenses would not be covered. On the other hand, if Antonio was injured in an automobile accident while traveling from the Rome airport, due to the carelessness of his taxi driver, his resulting medical expenses would be covered by his travel insurance policy. Benefits. The benefit is usually received as a reimbursement of expenses. The insured pays for the medical expenses when they occur and then submit a claim to the insurer with accompanying receipts. This reimbursement system allows the insurer to pay for their health care expenses as well as the provincial health plan to pay for their portion. To qualify for a benefit, the insured must immediately contact the name and number provided on the insurance card they were given when they bought the policy. There are standard exclusions for the benefit, such as attempted suicide, war, self-inflicted injuries, normal pregnancy, and drug or alcohol abuse. There may be other non-standard exclusions such as claims arising from a hazardous activity, that is, parasailing, scuba diving, etc. Travel to countries which are on the travel advisory list published by Foreign Affairs Canada, or when treatment is obtained for a non-emergency. Factors affecting premiums. The amount of coverage and length of the trip are the main factors in determining the premium.